Let's start. Let's start with a revision of a new topic, risk management. Let's start with the revision of a new topic, risk management. Now, before I move into this topic, let me discuss briefly a theory with you from my notes. I'll discuss with you theory so that by the time rest of the students will turn up, and MCQs can be framed very easily in this topic, very easily, because there are a lot of theoretical portion on which it can be based. Plus, in the last few attempts, questions which have come have been slightly off track. So you should know how to do it. So at least the questions which came in the latest trend, we'll check that out, and to avoid any confusion, we'll keep as per the institute's view. So let me move to Shiva. Risk management. I'll discuss with you theory quickly so that you are this chapter number 9. Yes. Theory might not be with you, it's okay. When you go back home, if I have this separate, I'll share with you the theory separately, in fact, if required. Now, what could be the MCQs based on? They could ask you on a strategic risk, compliance risk, operational, financial risk. In financial, you will have something more, and these are different type of risk. Strategic risk is not changing your strategy and continuing with the old strategies. That's a strategic risk which comes out. The biggest failure which we have is Nokia and a Kodak, which comes over the period. Why it arises? Question can be how it arises, how it can be reduced. So there could be different type of questions which can be framed on this word. It could be outdated technology, change in customer preference, new competitor entering the market, change in material cost. Reduction can be done by any of the following: by regularly updating your technology, changing the product as per the requirement of customer preference, and keeping a cost control. That could be the framework. Compliance risk, I do not even have to tell you because you have been very expert at it. What you do, GST audits, etc., or any of the internal controls, rules and regulations, they are basically compliance. If anyone is not complying with the compliance risk, there could be a threat to the survival of a business. In the last 1 year or so, in fact 2 years, you would have seen a lot of companies have come under this framework, and there has been huge penalties which have been imposed in some of the listed companies, at least I can tell you. So this has become very important in the last couple of years. Operational risk is what could be the internal risk which could be there, which has happened as some time of a frauds in the banking system. Maybe their internal controls were not strong, or maybe they did not have the proper processes in control. So above risk can be mitigated by creating strong internal control systems. Financial risk arises because of following reasons. Now, financial risk could be one of the most important. Under this, there could be certain parts which can arise. Is counterparty, political counterparties, parties defaulting, political events which take place. Interest rate risk is a separate chapter altogether. Currency risk and liquidity risk. Currency risk is foreign exchange. Liquidity is when you are having a shortage of funds with you. So counterparties, the risk is in which when you transact with some party and they are not able to deliver the goods as per the terms and condition, or the payment does not come on the time, and so on. So this risk arises because of that reason. And how do we know? Basically come to know is when someone is not paying the salaries properly, when someone is not depositing TDS properly, when you have a due date as 1 month and you do not receive money for 3 months, you should start understanding there is some problem. Mitigation can be done. How to manage the risk is carry out due diligence. Do not overcommit to one party. That means in your portfolio you do not have exposure more than a certain percentage. For example, if you are giving one party 20% of, or dealing in 20% of your volume or the amount terms, and that party itself winds up or defaults, then your business can have a huge risk which can be there. Some of the experiences you can take from some of the companies which are now in well positioned phase. Some IT companies, when they initially started, their exposure to some clients were very huge. Now they have made sure that the weightage of the revenue terms does not exceed maybe 3 to 5%. so that it easily makes sure that even if one contract is over or they're not getting that money, so default or risk would not be there too much. Political risk, you will be watching this in the upcoming few months, couple of months, that what kind of risk is there, because anyone, even from outside, someone wants to come to a country, they want a stable government. If the government is not there, policies are not clear, things will not turn out, and they need to have a good relationship with that particular country. Interest rate risk is the chapter we'll discuss, I think soon after this chapter only will come back. All the techniques will be discussing in that. This will be there. Currency risk we have already discussed. Forward money market, currency options and currency futures, some of them. This we have already discussed. Liquidity risk is exactly on the same parameters. Then he might ask you, risk could be evaluation of financial risk from different point of view. It could be from the stakeholders point of view, they could be employees, customers, suppliers. It could be company's point of view. That means if the company borrows excessive debt, which you might have seen in one of the unlisted companies in the education side, the companies which borrowed excessively and they are not able to service. So I'm without taking a name, I'm just telling you, when you go back, open up any newspaper, you will find maximum companies in an aggression heavily borrow debt, maybe for M&A activity, maybe for expansion, maybe for some other activity. If any problem happens, what they imagine is 5-year vision, 7-year. If anything happens before that and they are not able to service, then things can drastically go bad. Means it can happen that you have a $20 billion market cap, it can come to a $1 billion market cap. You will not even realize what had happens. So which has happened with one of the companies. So it could be this part here. In fact, it not one company, you find n number of companies. Any companies which generally you find winding up is only because of the excessive exposure to the debt which comes out. Government point of view, also you can be read that the failure of a bank like Lehman Brothers made sure that everything went for a toss in 2008 and so on. So this could be there. Now practically when these kind of risk, why I discussed very quickly and just to have a glimpse of it, was you should know that strategy, compliance, they can be framed as MCQ, or he can give you one MCQ and small type of case study, and he can ask you this type of risk is which risk, this type of risk is which risk, this type of risk is which risk. So you should be able to identify. Strategy I am not changing, technology I am not changing, there are some rules and regulations, there is some political events, there is some interest rate, there is some counterparty default, or there is some control system. So which kind of a risk it will fall to. So that could be the MCQs which can be framed on this parameter. Coming back to the practical side of it, not taking much of a time, although we can go in the depth of it. The value at risk, the objective of this topic is, if I invest in somewhere, I want to know what could be my loss capacity. It could be maximum loss, how much I lose in a 1 day or 10 days. Generally he gives in 1 or 10 days. It could be 4 or 5 days also he can give you. So how much could be my maximum loss and with what confidence I am saying it. For example, I say if I invest 2 crore rupees and I ask my portfolio manager what would be my loss. He says, sir, your loss will not exceed maybe 5 lakh rupees in a 10-day time. I ask him, it's general language if I use, I say probability. So if I ask him, is it confirmed? He say, sir, I'm 99% confidence our loss will not be exceeding 5 lakh, but there could be 1% chance exceed 5 lakh, or it could be 95% confidence level. We use a concept of a normal distribution. So what comes here? Just quickly read at least the first 2 parts. I'll discuss with you. Practical we'll discuss on this part only. VAR, very, very important concept from this chapter. So if you we try to read this concept, it says how much your investment can lose with 1 day, 10-day time, what is the confidence level we have. Generally the features of this when we speak about is the time period, with what level of confidence he says. We use a concept of the normal distribution table, Z score basically. So without going into how Z we calculate, how etc. Normal distribution table we use, but he'll give you the value, that what values comes for it. In fact 2 values which I think some says you can remember 3 values, but I think At least two values you can remember, although he always gives in the question that the value with respect to 95 and 99 percentage, the values he'll give you. So when you go back home, you can look up your normal distribution table, or let me just check normal distribution table once, show you. In derivatives, in Black-Scholes you would be using that. It's a derivatives. So if you look at the normal distribution table, when we say with, for example, when we say 95% confidence level, the value equal to it comes as 1.65, and when we say a 99% confidence level, value would be 2.33. So two values you can remember for a reference purpose, which I'll show you in the questions also. So if he says what is the VAR when you have a 95% confidence level, we'll be using 1.65 as our value and 2.33 for the 99 percentage when it comes out. Coming back to it, risk management, that will be given to you. I'll just quickly look at one data so that we get working of it. Now application is basically, if someone is asking to manage his portfolio, he'll tell the portfolio manager that this is the maximum loss I can go through. So when you're creating your strategy accordingly, you can make sure that my loss does not exceed this much. What concept will be used, or what data points will require is investment value I'll require that the normal distribution value, and third I'll require standard deviation per day. So what is the standard deviation or fluctuation can come? Standard deviation itself is a risk, but when we are going slightly beyond it with the confidence level, we are using a normal distribution table. Although standard deviation itself is a risk, movement of the deviation, but when I'm saying with the confidence level, means when I'm saying that when we use a normal distribution, it's a distribution of the data accordingly. So what we try out is we saying 99% we are confident, or 95 I'm confident that loss will not exceed. Standard deviation is deviation from the mean. So you can even imagine, sir, if loss we were supposed to calculate, we could have even seen the standard deviation. But when we say with the confidence level, the concept of the VAR comes in. Generally in the NSE or when stock exchanges use that VAR, I think they give the values 99%, 95, 99 we'll assume, that's much safer it. Now just to look at a simple data point, I have taken the data from the book itself. This is not how the question would be available to you, which I'll show you. Have I given you question number 1 in your notes? Just see once. Do you have question number 1? Yes, that's fine. In the notes handout, did they give you the handout today? Risk management. Maybe you can download from the drive, or just ask Shiva once. Did he get the handout? So you'll have, I think, let me see, I should have given you. This would be there with you, don't worry. This you should have. Drive you can download, that's fine, but just ask Shiva once. Maybe he would have got the printout and he might not have given it to you. The concept of VAR, this is not how the example will come, just to understand how we move forward. The concept of VAR can be understood in better manner with the help of the following example. Suppose you hold 2 crore shares of X whose market price standard deviation is 2% per day. Assuming 252 trading days in a year, determine the maximum loss over a period of 1 trading day and 10 trading day with 99% confidence level. Now when we say 99% confidence level, the value it derives it, he will give you, just to explain, he has given, assuming share price are normally distributed for 99%, the equivalent Z score from the table is 2.33. So remember that 2.33 for 99% confidence level, and remember for 95% was 65. These two values, remember it in case he does not give. Then how do we do it? Basically is the maximum loss for one trading day. When we say a maximum loss for one trading day would be, now it would be how much amount we have to 2 crores. So 2 crores into 2 percentage is my standard deviation in the rupee term. Answer can come rupee in the percentage. 2 crore into 2 percentage in the lakhs he has given is 4 lakh. This is 4 lakh, and when we multiply it with this is standard deviation in rupees. When we multiply the standard deviation in rupees with the 2.33, this will give us 9.32 lakhs. So reading of 9.32 lakh is with 99% confidence level, you can say if the 2 crore rupees is invested, then in one day the loss will not exceed 9.32 lakh. And there is concept of something called periodic adjustments of the standard deviation, which I am not discussing here. So if it 10 days comes, let's suppose, so for 10-day period when we say, for 1 day how much do we have? 9.32. So if 9.32 is for 1 day, for 10 day would be, you can multiply by under root 10. You can multiply by under root 10. It's basically when you learn statistics more, you will be learning something called periodic adjustment of standard deviations. So in that, the under root concept you will understand. But anyhow, just remember, if it was 4 days, I could have done under root 4 maybe. So 1 day is 9.32. For 4 days it will be 9.32 into under root 10. How much do we get? How much? 29.47. Now I should be able to read out what does it mean. It means is basically we are 99% confidence that in 10-day time our loss will not exceed 29.47 lakh, or there is a 1% chance loss will exceed what? 99.47. That is exactly the meaning of it. So the meaning of the reading you should be able to do, please. The meaning is that what is the confidence level you have that the loss can exceed what level after a point of a time, and loss will not exceed after what point of a time. Just write down a small example which we'll do together. Let's put down a small example, please. Company A wants to invest. Company A wants to invest rupees 50 lakh. Standard deviation is equal to 1% per day. Standard deviation is equal to 1% per day. Find the maximum loss over one trading day. Find the maximum loss over one trading day and 10 trading days with 99% confidence level. Find the maximum loss over one trading day and 10 trading days with 99% confidence level. Now when we create a solution, you can find standard deviation in rupees term. 50 lakh is investment into 1% per day. That gives you per day loss 50,000. Maximum loss over one trading day with maximum loss over one trading day with 99% confidence. The Z equivalent score will be 2.33. 50,000, 2.3. How much? 1 lakh? 1,16,500. And maximum loss over 10 trading days with 99% confidence level is under root 10 into 116,500. 3,68,040, 368,405. No, no, it's he confidence level depends upon your what kind of a, it's a kind of a, you can imagine a probability. 99% is chance I'll not lose more than this. Just think from that perspective. So 95%, 99 is a general term. He might even give you 90 percentage. So that's a general concept of 99 and 95 percentage. What institute has been majorly using. So he gives the value. What he wants is that if I lose. That is perfectly sure that I lose out something. But with how much of the confidence level, or what is the probability that I will not lose above this certain amount, or what is the probability that I lose maximum this amount. That is what the confidence level tells you. That's it. The confidence level only tells you the probability. You can imagine in simple words, kind of a probability. How much is my probability that I'll not lose more than this? 95% chance I'll not lose more than this. 99% chance I'll not more than this. If I use this general term, it becomes a normal portfolio. The confidence level is Z score because it has a concept of normally distribution of the data, assuming the share price are normally distributed, and hence we use. That means he is confident he will not lose more than this, and he will not lose more than this in a 10 days period of a time. One question he'll give you this. Next part of the question, let me do is this. You can try quickly. Question number 3, I think, book itself. It's single year, na? This you can try in the book itself. Question number 3. Done. Now, second variety he can give you is a portfolio. We'll not look at the answer, we'll do it on our own. Question number 4 I'm talking about. Following is the information about Mr. Z's portfolio. Investment in shares of ABC, investment in shares of XYZ, daily standard deviation 1%, coefficient of correlation is 0.3, that's R, and required determine the 10 days 99% value at risk for Z portfolio given the Z score from the table 99% confidence 2.33. This is exactly how he gives. Either he gives this way, or he gives you the table like this way, and or I think he will give you the table this way values. So anyhow he has been giving, but he does not give the value. Remember at least the two values. If you want, go back home and learn the 90% also. I don't think he'll give any other value than this. In this case, he wants to find the value of the portfolio. Let me put down the data. So 200 lakh, 1%, R is given. So 99% confidence, 10 days time. Before we do 10 days time, we'll always do 1 day time. 10 becomes easier for us. Now calculation up to 4 decimal points. So let's put down solution 4. Let's quickly put down. We have X, Y, Z and ABC. Investment is 200 lakh. This is also 200 lakh. Weights is half of 0.5. Standard deviation in percentage 1%, and I think 1% is given. Yes, 1%. That's 1%. R is 0.30. Standard deviation in rupees will come 2 lakh, 2 lakh. And 2 lakh. Now let's calculate standard deviation in rupee for 1 day. This is individual. We are trying for portfolio now. Standard deviation of portfolio. Standard deviation of portfolio in rupee for 1 day. Standard deviation of portfolio is equal to, I am putting a different formula what we have learned in the portfolio. So just put it. I'll tell you why we are doing this way. We will do alternative also. X, Y, Z standard deviation score of ABC plus 2 standard deviation X, Y, Z standard deviation ABC into R. Now since we are doing in the amount term, we do not have to multiply by the weights. If we are using the amount term, so weights, if we are not multiplying, 2 to the power 2 to the power 2 plus 2 into 2. Sir, what is this 2? This 2 lakh into R is 0.30. R is 0.30. So 2 to the power 2, 2 to the power 2 plus 2 into 2 into 2 into 0.3. This will get what? 4 plus 4 plus 2.4. How much do we get here? 10.4. 3.22. That's standard deviation rupees for the portfolio. Standard deviation rupees for the portfolio. So let's suppose we would have applied the percentage formula. Then what? If I would have applied the percentage, let me try that also, what we have learnt in the portfolio. If you look at the percentage, then your formula will become the standard deviation of a portfolio is equal to standard deviation square of XYZ into weight square of XYZ plus standard deviation square of XYZ to weight square of XYZ plus 2 standard deviation XYZ weight XYZ into standard deviation. No, both are not XYZ, na? ABC, na? This is ABC. This is A, BC, ABC, XYZ, ABC into weight A, BC into R. So in this case, what was the standard deviation percentage? If I do percentage, then I would have to multiply by the weights. In case there is no percentage amount term, no weights to be multiplied. What do we get here? 1 to the power 2 into what? 0.50 square. Second was 1 to the power 2 into 0.50 square. 2 into what? 1 into 0.5 into what? 5 into what? 0.3 into 0.3. How much do we get here? Point total. First one 0.25 plus 0.25 plus 0.15 total 0.65 under root 0.8062. Now if you calculate now standard deviation of a portfolio in rupees, total portfolio size was what? 400 lakh into 0.8062, it should come 3.22 lakh. So if you are by chance doing in the percentage form, then please apply the weights. In case it was normal, it has to be the same, so it will come 3.22. Rest part will not change because our objective was to calculate the amount term. Now we can say maximum loss for one trading day, one day at 99% confidence level. Maximum loss for one day at 99% confidence level. Once you've done this, let me know. So I'll move to my normal one. Can I move back? So I move here. It says maximum loss. He did not ask, but calculate this so that life becomes slightly easier for you. Maximum loss for one trading day at 99% confidence level. Will be equal to 3.22 into 2.33. 4 decibels, 7.26 lakh, 7.50, and 10 trading days, 10 into 5026, 23.72. This is one variety of a question. Second variety of a question would be, in fact in this he can also do individually, can do, then there could be possibility of a benefit of diversification, so on, which I think will take a lot of time for them to reach at that level. So second type is reverse calculation. Now the questions which have been framed in the couple of years, in last 2 years, are reverse calculation. Let me go back. Can I move back? I'll move back here. Read question number 5 quickly, please. Read question number 5. On Tuesday morning before the opening of capital market, investor while going through his bank statement has observed that amount of 7 lakh is lying in his bank account. 7 lakh rupees were there in his bank account. Very good. This amount is available for use from Tuesday till Friday. 4 days. Tuesday to Friday. Tuesday, Wednesday, Thursday, Friday. Saturday, Sunday market is closed anyhow. Bank requires minimum balance of 1000 at all time. Investor desired to make a maximum possible investment at VAR should not exceed the balance lying in his bank account. Now understand what is the meaning of it. What we have been doing is, he want to find now investment I value, and he wants to make sure what investment should I do so that the loss in the 4 days should not exceed the amount lying in the bank account. Amount lying in the bank account is 7 lakh. Out of that 7 lakh, bank that says 1 lakh would be 1000 would be what? Minimum balance. So maximum amount he can lose is what? 6 lakh 99. Understand the meaning of it. Let me look at this question. If I would say I can maximum lose 23.7253 and reverse calculate for me what could be my investment. So when you reverse calculate and go back to check your investments, your investment would come 400 lakh. I'm just assuming that. So basically he has given that maximum amount of a loss here could be 6 lakh 99,000. Loss is 6,99,000. So he has to reverse calculate what could be the investment level. What we generally do is we calculate, if I look at the single data, what I do is I calculate standard deviation in rupees. So this is my 50 lakh into this will give me 50,000. Then I calculate for 1 day and then I calculate for 10 days. If it is 4 days, 4 days. Now what he's saying is my loss at this level should be what? 6,99,000. If I know, basically I need to calculate this 50 lakh investment value into standard deviation per day gives me the standard deviation rupees for 1 day. Standard deviation rupees 1 day into 2.33 gives me this value here. So I do not know this value x. If this is x into 1, this will come in x. This into this value will come in x. Now when I multiply under root 10 into the x value, this value should be equal to what? 6,99,000. So I have to reverse calculate my I value, investment value. So basically what question is asking us, again I am reading it please. He says on Tuesday morning the bank statement showed a balance of 7 lakh in his bank account. 1,000 rupees is the minimum balance. That means you can lose up to 6,99,000. So maximum possible investment value to tell, deviation of market price of securities 1.5% per day. The confidence level is 99%. He has given the Z value. You will pick up 90, how much percentage? 99. So approximately this value will come 2.33. 2.33. Even if it does not give this value, pick up 2.33 only. This is the value. So you have to reverse calculate the value. You have to reverse calculate. You got the objective now. What has to be done? If you want to put a straight simple line, you can put down a simple line please. Capacity to lose is rupees 6,99,000. Just put a small line if you want for reference. Capacity to lose rupees 6,99,000. 6,99,000 in 4 days. In 4 days, maximum in 4 days. At what level of confidence? At 99% confidence. Now let me show you the way of doing it, and then we'll try to read the sentence again. For example, let the amount of investment be equal to what? X. If the amount of investment is X, standard deviation will be 1.5x. Standard deviation per day will come X into 1.015. Maximum loss over a period of a one trading day with 99% confidence would be 0.015x into 2.33. I get in what term value? X term. And then when I say 4 trading days would be under root 4 into what? 0.03495, and I know this value should not exceed what? 6,99,000. I get my value as what? 1 crore. So how did I get, sir? 619. Amount available in the bank 7 lakh. Minimum balance to be kept is what? 1,000. This is 6,99,000. Now how do I read the sentence? I read this way. From the above we can say if standard deviation per day is 1.5, then a trader can be 99% confident that his maximum loss over a period of 4 days would not exceed what? 6,99,000 at investment of what? 1 crore. Should read the language. The second question would become easier for you, in which he'll give combination two parts here. Copy down quickly please if you want. Let the amount of investment be equal to X. So we have let the amount of investment be equal to X. What we have done is exactly same way. Only thing is now the maximum loss value was given to you. You have reverse calculated what amount of investment. That's it. You reverse calculated the amount of investment. So X is 1.5 per day would be 0.015. Maximum loss over a period of a one trading day with 99% confidence level is given for 4 trading day would be this. Book also gave the answer, but let's do the same way what we have been maintaining for rest of the questions. amount available came from here, and then we can say from the above we can make out that if standard deviation per day is 1.5, then trader can be 99% confident his maximum loss over a period of 4 days will not exceed 6,99,000 at investment of 1 crore. We require to find that I value, investment value. It's not 100%. How can it be 100% when we are using this 2.33 value? So when we are using this 2.33, and you do one thing, you use 1 crore and then use this 2 point. When you are using this normally distribution table value, then how it can be 100%? You do the reverse way, your loss will come 699. If you use this value, that means you are only 99% confident, not. Huh. Huh. Hmm. You have 1 crore amount and rest data is same, 699 is not available. Then go back home and do the reverse calculation. If it comes 699 by using this value, then means when you use this value, what is your confidence level? 99, so it's 99% only. If you do not use this value and then say 699 is coming, that 100%, that's a different game together. When you use this value, that means you are only doing a reverse calculation using 99%. So if this value is given and you are going forward using this value, then 699 comes, it's a 99% confidence only. Read the next question, please. I'll read out from here. Sixth question. We read sixth question with you. Mr. Bull is a risk taker. He takes position on a single stock for 4 days in a week. He does not take position on Friday to avoid weekend effect. Generally, traders do not take a Friday positions and take position only for 4 days in a week, that is Monday to Thursday. He transfers the amount on Monday morning and withdraws the balance on Friday morning. So the amount remains in the bank for the position for 4 days. He desires to make a maximum investment, maximum investment where value at risk should not exceed the balance lying in his bank account. So he says whatever is the balance in my bank account, my loss should not be exceeding that amount. In previous question he clearly mentioned that was 7 lakh minus 1000. He says whatever is the balance, that's the loss he can bear. That is not the investment, that is the loss he can bear. The position by his manager as per standing instruction is taken on the free balance lying in the bank account in the morning on each Monday. It means the position is taken by the manager and the instruction is given that whatever is the balance is lying in my account, take that as a maximum loss level for the VAR per VAR and you create the maximum investment accordingly. On Monday morning, before opening of the markets, he transferred amount of 11 crores. He transferred amount of 11 crores. Now 11 crore is not the investment amount. 11 crore risk he can take. So you can imagine if 11 crore, in the previous case he was able to take what, 6 lakh 99. On 6 lakh 99,000 you were getting investment of how much? 1 crore. If 11 crore you can lose, prima facie, if I say, think of the situation, what would be the investment will be made? So something should come in mind. Generally what happens is, when you see this amount from the article's life position point of view, they start assuming this could be the loss 11 crore. This could be the investment. 11 crore is a loss taking capacity of his, and he is extreme bull, I think, extreme bullish. 11 crore. He transfers this amount, and instruction is very clear that whatever is amount is there, you take the position. A fixed deposit also matured this Monday. Now this was the ambiguous language. Your institute, why does it create? I don't know. Practical life, the does not happen that, oh, you tell me what time period the FD would have matured, what time period balance would have come, how would portfolio manager to come to know? These are all ambiguous language. I don't know why they create. If they have to test the knowledge, test knowledge accordingly. But these kind of problematic is there. Now what time period it came, how do I know? If it come in the evening, he will not take a position. If it come in the morning, he will take a position. So there is a challenge which comes out. A fixed deposit also matured this Monday. The maturity amount is 63,42,560, was also credited to account by bank in the morning of Monday. However, Mr. Bull received the intimation of the same in the evening. Bull did not get the knowledge. He will come to know the end of the day that there was some FD matured. A person who is ready to lose 11 crore, he will not keep a track of 60 lakh, 50 lakh investment when it is maturing. So he came to know in the evening. Now problem is, should I create, and after that bank needs minimum balance of 1000 at all time. To create problem, 1000 rupees in 11 crore. So should he take a position 11 crore minus 1000, or should the position be taken 11 crore plus 63 lakh minus 1000? Now if you would have asked me, as per the language specification, he is using word amount credited morning of Monday, and as per the standing instruction is taken free balance lying in the bank account in the morning of Monday. It means he will take into account 11 crore plus this minus 1000. Second opinion could be, Bull came to know in the evening. Bull, he will not keep telling his portfolio manager. He told whatever is balance, you take the position. So when portfolio manager would have opened his bank account, he would have seen how much amount, 11 crore plus the FD amount, and subtracting minus 1, he would have taken the position. So ideally the position would be taken on 11 plus this minus 1000. So it should be, technically also it should be taken on this only. But anyhow, this was an ambiguous language. Bull came to know in the evening, or maybe he would not see the statement. He sees statement 3 days later, he'll come to know after 3 days time. He will not even come to know there was FD maturing. So this line does not mean anything, that Mr. Bull received intimation on the evening, because as per the standing instruction, the portfolio manager is very clear, whatever the amount is there in the bank, I'll take the position accordingly, and that position was taken. Then value of Z score, required confidence level of 99% is 2.33. The other information available with respect to stock of X and Y which are under consideration for this week is as under. X and Y, this is given. Recommend a single stock where maximum investment can be made. Exactly on the similar lines. First new point was FD. Second new point which comes is, instead of one stock, two stock came. Third, standard deviation is not given. So you'll have to calculate the standard deviation. Problem was not standard deviation. You can calculate the standard deviation, probability is available. You'll calculate mean, then the x minus mean, etc., and then square of. You can calculate easily. That is not the problem at all. Problem comes is, should I use the standard deviation which comes for 1 day? Will the standard deviation be 4 days? Will the standard deviation for 5 days? Because if it is not 1 day and any other days 5, etc., then I have to do something called periodic adjustment, which I am not technically touching it, because problem will occur if that happens. Technically, if it is 1 day, periodically how do we calculate that, how the standard deviations are calculated? So the problem is what has to be done, and I think the safest side is, if nothing is given, assume whatever you calculate is for 1 day only it is coming. If it comes for 1 day, that, because if it was not for 1 day, then certainly what we do under root 4, under root 10, we do only for reason that they are coming for 1 day. If they are not coming for 1 day, these under root 4 and 10 would not be used. Then it would be something different. There is some reasoning of doing it. So what you do specifically is, whatever standard deviation comes, and opinion also taken by your institute is same, I think next time also they'll take a same, because otherwise the question becomes very technical. it's for a single day which is coming, and since it comes for a single day, it is a single day, then automatically you create what, that x equation, and will move forward. So what we'll do is, first part we'll calculate is the standard deviation, calculation of standard deviation. So probability, a portfolio concept came into the picture. Calculate the mean, and then accordingly you calculate. So what we do is, sir, for example, we calculate first part, calculation of standard deviation for x. Calculation of standard deviation for x, it's a probability into x dx pd square x. So that value comes out, and then similar we'll do for the y. Quickly copy that part, then we'll move forward. We calculate, and we'll calculate that standard deviation quickly, please. Calculate the amount available for risk for x and y. Before I show you, calculate the amount available for risk for x and y. Both will be same. The standard deviation is assumed for 1 day, otherwise there would have been some complications. Amount transferred is 11 crores. Realization of FD, should I show you the amount? Let me show you the amount. FD realization amount is 63,42,560. Minimum balance is 1000. So you can call it as amount available for risk bracket var. Amount available for risk bracket var. Amount available for risk bracket var. How much it comes? 1163 41 560. Is that fine? Now you can do independently or same structure we can do. I'll just show you the hint. First part I'll show you. Second part, net answer, I expect you to calculate. So now you have every data available. 2.33 value you know. Let me show you the last of the value here. So what I'll show is, in fact, this much I'll show you. After that, I'll ask you, look up please. This is under X and this is under Y. We say let the amount of investment X, in the Y will say Y, 1.4%, 2.19, 0.0114x, 0.0219y. Let the maximum loss over one trading day with 99% confidence is 0.0265, means when you multiply with this and this, and then rest you have to calculate over how many days? 4. So you will calculate in 4 and should be equal to what amount? 1156. Reverse calculate the amounts for me please. The numbers would come very huge. Exactly same way. Now the question has become exactly the previous one. So this much I'll show you. Next part you calculate for me and tell me what comes out. Next part you calculate for me and tell me what comes out. It's x into 1.14x, 0.0114x into 2.33, 0.026562. Y comes out and then we have 0.015 this. Equate this value with the value 1163, 41, 560, the bar value. And very huge amount will come. You are ready to bear a loss of 11 crore 63 lakh 41 560. You are ready to bear a loss of and actually I don't know, I am 99% sure someone who is framing this question, he would know someone who can bear this loss. So you can imagine people are there who takes position. Otherwise, examine at theoretical level, its thinking wise is difficult. It's this kind of a loss. How much amount of investment? Should I show the next part? Two very huge amount comes. 219 crores only, na? 1, 2, 3, 4, 5, 7 zeros. Okay. 114 and 219. No, sir. He is asking a recommendation. Where should we invest? Where should we invest? One answer I am getting is buy. Go beyond article CA level and become a businessman, and then tell me why X. Under both circumstances, you are ready to bear loss of what? 11 crore 63 lakh. Why should I invest less and bear a loss of 1163? Let me invest higher amount and then bear that loss. Understand the objective, please. I hope you're getting that. When I know my loss is 5,000 rupees or whatever rupees is under all circumstances, and I'm getting opportunity to invest what? Bigger. By chance that loss does not happen, then my earning would be higher. That's why the X recommendation would come. Position will be taken in the X part. That finishes our risk management. Let's move to that finishes our risk management. When you go back home, try once more, please. And there could be ambiguity in the could be a possibility in the assumptions, but I think institute would have taken the same assumptions only. So we are continuing with that. Should I show the answer once? If you want to copy. If you've done, that's fine. Let me know. Let's start. Let's move to now. Let's start with interest rate risk management. Another topic which has over few period has assumed some significance now. Interest rate risk management. Yes. If you have the notes with you, it's okay, or you can download the slides from the creative the drive. The link would be there under the video, I think. The first of the note which I am talking is FRA. What type of question? It could be, in fact, when we are reading the theory just now, risk management, we were seeing that it would be FRA, interest risk management, cap, floor, collar, etc. Everything will be studying in this part only. So FRA is a forward rate agreement. Forward rate is exactly on the similar lines what we do in the forex. If I look at this 3 into 9 FRA, that means you can enter into contract today, and basically after 3 months for 6 months, after 3 months for 6 months, 3 into 9, after 3 months for 3 into 9 differences 6 months. Two type of questions would come. One, the settlement. Second would be the arbitrage. Now one thing you understand from here is institute has modified one of the answers to the questions in this FRA only, although they modified answers on almost every part going forward. I don't know, 2 to 3 times, and then when the dispute comes in, they remove from the study material itself. So that's easier for them to remove it. In the FRA, for example, when you start here, you're doing an agreement. I'll just read out and why do we do agreement. This slide will tell you so that you get the objective clear of it. FR is the agreement in which borrower or lender will enter into contract with the bank to borrow lend certain amount after certain period. After certain period is, let's suppose 3 months here. For certain period is 6 months at certain rate which is decided today. That is the objective of FRA. Starting today, maybe I know I'll start some project after 3 months time, and I have a fear interest rate might go up. So I enter into an agreement with the bank and freeze by rate today itself. The bank I'll come to you after 3 months time, and for 6 months time I need a loan. Tell me the rate today. I'm not borrowing today. So rate decided today. Now objective is actually what happens is, for example, 3 into 9 FRA. A person will enter into contract today after how many months? 3 months. Means he is doing today only, borrowing for 6 months. Let's suppose borrower freezes rate at what? 9%. No matter what the rate becomes after 3 months, net cost to the borrower would be 9%. What happens is, let's suppose the rate became 12%. The bank, you agree at what rate? 9. You'll go to the bank and say, bank, I need a loan. Bank say 12%, but you'll say, I agreed with you at what rate? 9. Bank will give you 3%. You go to the actual cash market, club them, total costing becomes what? 12. Bank will pay to the person 3%. In case rate becomes 8, bank says, you said you'll borrow at what rate? 9%. So you have to borrow from me. You say, I'm not borrowing, let's cash settle the contract. 1% you pay to the bank and 8% actual cost. 9 came. Now earlier when the question used to come, the answer institute used to give somewhere here, but actually, you know, when the 3 months expires, lapses here, let's suppose, so rate you would know after what time period? 3 months only. So it is not the actual payment. Had it been actual payment, then I could have said yes, settlement will take place after a period of 9 months. But since you are settling, for example, you have done the betting today, when would you come to know betting has actually been exercised, or means in favor or against? You will come to know at what period? 3 months. So basically we'll try to settle down at 3 months time period. So this comes out. This is first part. Let me look at the first variety of a question which comes from here. The first question which has appeared 2-3 times, and we can do it quickly on that part. Eighth question. Read out quickly, please. Eighth. Messrs. Parker and Company. Read out this question quickly. Now let's look up the question, please. Mrs. Parker and Company is contemplating to borrow amount of 60 crores for a period of 3 months. In 6 months time from now, the current rate of interest is 9%. It may go up in 6 months time. The company wants to hedge itself against the likely increase in interest rate. The company's banker quoted FRA at 9.3. Now FRA at 9.3, that means bank says I can do the agreement, you come to me after 6 months time and borrow from me at what? 9.3. So we call it as 6 into 9 FRA. After 6 months, for how many months? 3 months. Difference of the 9 minus 3 is the period for which loan is taken or agreed upon, and 6 months is nothing but the period after which I'll come. What will be the effect of FRA if actual and the actual interest cost to the company if the actual rate of interest after 6 months happens to be what? 9.6. If it happens to be 9.6, what will happen? Now basically if I tell you, you said at what? 9.3. Rate became what? 9.6. So actual cost also will become same, 9.3, and who will compensate to the Parker and Company? Bank. So technically if you say they freeze the rate at what? 9.3. If the rate goes up, the bank will compensate to whom? Parker and Company. And be clear please, when you go, the rate would be settled where? 6 months time. So if the rate is settled at 6 months time, we'll say how much the amount will be paid. Amount payment would be done. How do you calculate amount to be paid by the bank to the Parker and Company would be 9.6 minus what? 9.3. This is into for how many months? 3 months. Into how many amount was? 60 crore. So 60 into 10 to the power 7. But this value would be settled at what time period? At 6 months only. So we divide by the discounting of 3 months, we do the discounting. So this comes the answer. If the actual rate becomes the after 6 months is 9.6, so compensation would be 0.3. And if I use this word amount to be paid by banker to the Parker and Company, 4,50,000 was standing at 9 months time, and when you bring it back 3 months, it's 9.6 by 100. The 6 months time would be 439,453. 439,453. So we say if the actual interest rate, we call it as if the actual interest rate after this becomes 0.3, so the compensation would be by banker to Parker and Company. Second part, rate becomes 8.8. Try to calculate the amount on your own, please. Second part, rate becomes 8.8. Try to calculate the amount on your own. Once you calculate, let me know the amount. 7 lakh 33,855. This amount who will pay to whom? Parker and company will pay to them. The costing for the Parker and company will remain at what? Whatever rate he has freezed, 9.3. So in brief, the answer we can write. Rest you can make your framework accordingly. This is the rate at freezed at. If it goes up, who will compensate? If it goes down, then Parker and company will pay. Basically, he was fearing an increase in the interest rate. They were ready to bear up to 9.3. So if the rate goes up, the banker will compensate and their rate will still be 9.3. And if the rate goes down, then they pay the difference to the banker. It's actually as good as the settlement in the over the counter. So they are given to them and rest remains the same. Done. Now second variety of it, before I move, in which arbitrage comes and discuss with you, let me do a small mathematics with you if you're comfortable. If you're comfortable, I'll straight away discuss in the question only by two ways. The mathematics generally troubles in the exam. So if I come back and discuss with you the second of the question which comes on the arbitrages, let me do some mathematics. FRA, what we are doing here is after 3 months for 6 months, or after 6 months for 3 months, means after some point of a time. Now what happens is, if you are standing in zero period, when you go to the bank and say, bank, I need to do some borrowing, let's suppose for 12 months, I'm using the words also as a borrowing, and bank says I can give you the rate as 12% per annum. That means if I borrow throughout, then my 100 rupees at the end will become what? If I borrow 100 rupees here, it will become what? 1112. Now let's suppose you do not want to borrow 100 rupees for 12 months, you want to borrow after 9 months for 3 months. So if you want to borrow after 9 months for 3 months, basically if I subdivide my period, one period becomes what? 9 months, second period becomes what? 3 months. For 0 to 9, can you know what would be the actual cost if I go and borrow? For example, I went to the bank, I said, bank, I want to borrow for 12 months. Bank will give me some rate. You go to the bank, if you want, tomorrow only you go and say, bank, I want to borrow only for 9 months. Bank will quote you some other rate. Let's suppose bank quoted actual rate 14% per annum, and if it was 14% per annum, that means your actual costing for 9 months would be what? 14% per annum, the costing will come 10.5. I'm putting in bracket as that 10.5. Now basically what I want is, if there has to be no arbitrage, then the same bank should quote what rate from here to here. It's again I'm saying, I did actual borrowing for 9, bank quoted me rate of 12%. If I do actual borrowing for first 9 months, bank quotes me rate of 14%. Now to the bank I'm telling, bank, I want to do borrowing, but not today, after 9 months for 12 months. So what should be the rate bank quote so that there is no arbitrage? So ideally we say the longer route, this is called a longer route, should be equal to 2 shorter routes. Should be equal to 2 shorter route. It means whether I borrow by longer route or whether I invest, I'm assuming borrowing here, whether I borrow by longer route or I borrow by what? Shorter routes. My amount should become what? 112. My amount should become 112. For example, if I buy 100 here, the value will become what? 110.5. 110.5. Now in this case, if I try to put my numbers, I say 12 months period, if it was 1 rupee, let's suppose instead of 100 it was 1 rupee, will become 1 rupee will become 1.12. Should be equal to a 9-month rate into a 3 months rate. That means 9 months will become 1 rupee will become 1.105 into 1 plus r. This mathematics, please remember it, because without this mathematics things will have a troublesome. So same bank I went, I said 12 months, what is the rate? 9 months, what is the rate? What would be the rate after 9 for 12 period? So this rate when he calculates, he says 1.12, 1.105 into 1 plus r, implies my 1 plus r should be equal to 1.105 12 divided by 1.105. How much do we get? 1.136 or 7, and R would be equal to 1.36 or 37. This is for how many months? 3 months. If this is for 3 months, that means if this is for 3 months, then full year would be into 4, 5.44% per annum. So we call it as whether if these are the rates quoted, 12%, 14%, and this, no matter you borrow by whatever rate, you will have indifferent point, no arbitrage. Same data let me use for the purpose of arbitrage, because the way your institute gives the answer, you should be at a final level comfortable with the mathematics. I cannot expect junior classes to have understanding of that, but at your level I expect you should be able to give a summarized answer the way your institute writes the answer. Now when I went to the bank, this is as per you, rate should be what? 5.44. Two things understand from here, please. Two things understand. This 12%, if, or look up, if by chance I give you 14% and I give you 5.44, can you reverse calculate the full rate 12%? Sir, what do you mean? If I tell you 14% per annum proportionately 3 months is 10.5, 9 months is 10.5, that is, you know, 9 months rate. If I give you this 5.4 for 3 months rate, can you reverse calculate the 12 month? Yes, you can easily calculate now. 1.105 into 1.036 is equal to what? That's 12. Now ideally what it means is, understand, means this 12% includes the impact of this 14%. This 12% includes the impact of 5.44. Sir, 14 plus 5.44 is 19.44. How come? It is not how come, it is 14% proportionately addition to 12 is what? 10.5, and 3 months addition is what? 1.36. Again I am saying, because get the comfort of the mathematics, else you will not understand the way your institute gives the answer. If I say in 9 months your 1 rupee becomes 1.105, and after that whatever you earn will become 1.0136. You have done quarterly compounding, semi-annual compounding. This I am doing what? 9 months and 3 months. What is your full year interest rate? When you multiply 1.105 into 1.0136 and minus 1 the principal amount, rounding off you get 12%. You say, sir, earning, now this is also half-hearted language I am using, earning 10.5 for 9 months, earning 1.36% for 3 months is as good as earning 12% for 1 year. This is not the best language. 14% per annum for 9 months, 5.44% per annum for 3 months is as good as 12% per annum. I hope you are getting my point. It means I can even use a language, 12% includes the impact of this entire 14% proportionately how many months? 9 months, 5.44 for 3 months. Is it fine? Now if by chance I give you this rate as 8%, which is given by the bank, if it is given by the bank as 8%, now what will we say is, actually problem will happen is only in these two rates. So we have to create accordingly the arbitrage. What answers given by the institute is, say you will earn 14% first 9 months, whether by a longer route or a shorter route. By a longer route, when you are earning 12, actually your earning is the language, look at my language, when you earn by 12, actually your earning is 14% proportionately for 9 months, 5.44 proportionately for 3 months. But when you give this language at 8, the arbitrage would come by looking at 5.44 and 8, the language would change accordingly. 14 is as it is, and then you will create an arbitrage. Basically, or let me use this word, let's suppose as per the rate should be what? 5.44, and rate he is quoting what? 8. Bank is actually quoting 8. Sir, how can bank quote 8? Maybe some other bank is quoting 8. I went to 3 banks. I went to 3 banks. One bank gave me this rate 12%. Second bank gave me what? 14%. Third bank gave me what? 8%. 5.44 is my calculation. That if I take 12%, if I take 14, according to me, rate should be what? 5.44. It's 5.44. But what is happening is the bank is quoting me what? 8%. Now, if bank is quoting me 8%, you tell me what should I do? If bank is quoting me 8%, you tell me what should I do? Actually, you look at what happens. As per you, the rate quoted by bank is more or less? More. You went to the bank, you said my borrowing should be at 5.44, but the cost is coming as what? 8. You will not borrow at 8. You will do what? Borrow at this rate and invest at this rate. Borrow at this, invest at this. We can do it easily. Let's suppose 100 rupees I borrow at 12% becomes what? 112. 100 rupees I borrow at 14 for 5, 110, and then this proportionate will be what? 2%. So I borrow cheaper, borrowing will be 112. Investment via the expensive route, 100 into 1.105 into 1.02. How much investment? 112.71, something what comes out. Basically 110 into 1.02. Sir, what have you done? Let me draw it in a nicer way here again. This is 0 period, this is 12 month, this rate is 12%, this rate is 14% per annum and 10.5, and as per you rate should have been what? 5.44, but he has given you what? 8% it comes. Now that means as per my vision it should have been 5.44. Since it is expensive, I'll borrow this route. So if I borrow this route, let's suppose 100 rupees, how much I'll pay? 112. If I invest via this route, arbitrager, if I invest for 9 months, it will be 110.5, and then contract to invest for another 3 months at the rate of 2%. 110.5 into 1.02, how much do you get? 112.71. So this is repayment, this is investment, arbitrage profit is what? 0.71. This is how a general layman would do. But at a final level, how would you do? You should be doing what? This is one part of doing. This also you can do. I would have given the cent percent marks if you do this way, but your institute will give the answer. Look up how. When I say this 12%, this 12% is composition of 14% and 5.44. Sir, but it is not 12. 14% proportionately, 5.44 proportionately. But in a layman's language, we call it as 12% includes 14% and 5.44. So when I borrow at 12, I can even use the language. I'm saying again, please. When I borrow at 12, I can even use the language. I borrowed at 14% proportionately for 9 months. I borrowed at 5.44 proportionately for 3 months. This language I can use. And now when I'm investing what? 14% proportionately for 9 months and 8% proportionately for 3 months. Now, sir, we are borrowing 12. Borrowing of a 12 is as good as 14 plus 5.44. So net answer would be borrowing at 5.44, investment what? 8. Because 14 is common in 12 and this both. Understand what I'm saying, please. So you should be very comfortable when you do the questions. Please, mathematically should be comfortable. This is composite of 14 plus 5.44 and the lower root is 14 plus 8%. So if you say I am borrowing by 12, it is as good as borrowing by 14 and borrowing by 5.44, because 12% is nothing but it's a composition proportionately of 14 and 5.44. And when you are investing by 14 and 8, since 14 is common in the 12 and this, the first 9 months are common. Actually, you are getting that profit only because of what? Last 2 months. You'll say my borrowing is 5.44, investment is what? 8. So I'll show you the answer in both the ways. Whatever way you are comfortable, do it, please. But mathematically should be confident enough that when I am reading the rate, I should be able to. So if at final level we cannot read this rate, sir, how this is equal to this because mathematics works, then there is a problem which comes out. Now let me show the questions which will come and how he will frame the answer and how you should be framing the answer. Look up, the question number is 7. Look up, question number is 7. The following market data is available: spot yen USD 116, deposit rates per annum dollar yen, these are per annum rates only, 3 months, 6 months. So yen will have a same, so we are not technically doing anything. FRA for yen is nil, it's okay. What should be 3 months FRA, 3 months forward? So he is talking about what? He is talking about which currency? USD. 3 months, this is per annum rates, these are per annum, and he wants to know what? 3 months FRA at 3 months forward. If I put it in diagrammatically, first part answer. If I put in diagrammatical presentation, first part answer. Look up please, you have the data in front of you. 3 months after how many months? 3 months. So 3 into 6. 6 minus 3 is that period, and starting period is what? 3. So we put starting period first, difference of 6 minus 3 is that period. So we say, if you look at this please, 0 to 6 months. Sir, what have you put? 6 months rate he has given what? 5. Per annum or only for 6 months? Per annum. That means proportionately for 6 months is 2.5. 3 months rate he gave what? 4.5. Proportionately for 3 months is what? 5. We want to find what? This rate. So technically this is not arbitrage, this is normal calculation. We say the 6 months rate should be equal to what? 3 months into 3 months. 6 months rate should be equal to 3 months into 3 months. 1.025 is equal to 1.01125 into 1 plus R, and when we solve we get what? We get this 1.36. If that means, this is coming, how it is coming 5 point, maybe it is coming same, but that rates were not same, na? They were rate 12 something else, na? It's something different, it's okay. So basically, how do we read, sir? We read if the rate quoted by bank after 3 months for 3 months, after 3 months for 3 months is 5.44% per annum, then there would be no arbitrage. Then there would be no arbitrage. That's basically a calculation of the rate. That is basically what has been done, is exactly calculation of this rate has been done. Now second part I'm reading now. Second part. In the second part he says is, in the second part he says 6 months is the 6 and 12 months rate are 5 and 6.5. So basically 6 and 12 months rate means if I go by longer route, the rate is what? 6.5. So my 1 rupee will become 12 months is 6.5. Proportionate is also what? 6.5. Sir, why does he write like this? 6 months are 5% in this. Actually, when you go to the bank and say, bank, I need money for 6 months. Bank will not do any proportionate thing for you. Bank will say, this is the rate. You do proportionately. You go to the bank and say, I want to do 9 months rate. Bank will quote you per annum. You go to the bank and say, I want 3 years rate. Bank will still quote you per annum rate. That means this 5% is rate for 6 months. This 6.5 rate is for 12 months. So 12 months proportionately or non-proportionately same. 5% mean proportionately I'll get what? 2.5. Now if I tell you from 0 to 12 months my full year rate is 6.5 and 6 months rate is what? 5% is 2.5. So can I find this second rate? What should be the rate? Can I find this second rate? Mathematically, you'll say, sir, 1.065. 1.065 should be equal to 1.025 into 1 plus R. How much do we get? 3.9 or 7.8. That means as per your rate should be what? 3.9, 7.8. Now let me do my logical understanding once again. Sir, how did we? I hope you are able to do mathematics. Sir, how did we do? Longer route was 1.065 should be equal to 1.025 into 1 plus R. So this is R is equal to 7.8. So if I read, how do I read? Sir, this 6.5 includes the impact of this, includes the impact of this. If I say I am investing by 6.5, I'll say it is as good as investment of 5% for 6 months, 7.8% for 6 months. If I say I am borrowing by 6.5, proportionately it means 6 months borrowing at 5, 6 months borrowing at 7.8. Now, after that bank says, a bank is quoting 6 into 12 FRA at 6.5 and 6.75. Why two rates he gives? Because one is the lending rate and one is borrowing rate. And technically we are not debating, sir, if it comes higher, one lower, etc. We are assuming that both rates are coming, since in this case both rates are coming lower than this. Both rates are coming lower than this. First of all, if bank is quoting two rates, let's suppose 6.5 and 6.75, logically tell me which rate bank will, means which will be borrowing rate for you and which rate will be investing rate for you. Bank will always give you what? Higher borrowing and cheaper investment. So you will do investment at what? 6.5 and borrow at what? 6.75. You will borrow at 6.75. Now as per me the rate should be what? 7.8. Both rates are lesser. Let's not even debate, since both rates are lesser. So if both rates are lesser, that means when I did my calculation, as per me the rate should have been what? 7.8. I went to the bank and bank is quoting me cheaper rates. Cheaper items will always what? Buy or borrow. It's a contract to borrow or buying. So if I borrow, that means I'll borrow what route? I'll borrow shorter route. Invest what route? Longer route. Now I'm using my words again. If I invest about longer route, I can say as good as investment at 5%, investment at 7.8%. And when I'm borrowing by a shorter route, I say borrowing at 5. So 5 is common, whether I use or do not use, it's as good as I have borrowed this at what rate? I have invested at 7.8 and borrowed at what rate? 6.75. I hope you are getting my point, please. So when you use this kind of language, this is exactly how your institute uses. I have done in a lengthier way also to explain the concept. As per me, the rate should have been what? 7.8. I went to the bank, they gave me actual this rate. Since it is cheaper rate downside, so downside I'll borrow. When I borrow downside, I'll say my borrowing, yellow eye writing please. I borrowed at this rate and I borrowed at this rate. I'm not using a proportionate word. It automatically means proportionate. And I invested via what route? Invested via 6.5. But when I say when I invested via 6.5, it was a combination of this and it was a combination of what? 7.8. So I can even use my investment is done at what? When I say, sir, my investment is done at 6.5, it is as good as 5% for how many months? 6 months, and 7.8% for how many months? 6 months. This is as good as my investment. And my borrowing is done at what rate? 6, 5 and 6.75. Since this 5 and this 5 is common, the net answer becomes is borrowing done at what rate? 6.75. Investment done at what rate? 7.8. So we say, since actual FRA quoted by bank is less than theoretical FRA, FRA is what price? Underpriced. Hence buy this FRA at 6.75, invest this FRA at 7.8. That's one way. Second way, what could have been done? Since you found the route, you'll say assume 100 lakh, borrow 100 lakh for 6 months at 6 months LIBOR. That means this route. Contract to borrow. Why contract? Because after 6 months, for 6 months you'll do what? Contract to borrow. After 6 months, for 6 months, so 102.5 into this rate proportionately 1.03375, outflow will be 105.96 lakh. And you had, since you borrowed in 0 period, investment was done longer route, how much amount? 100 lakh. What rate? 6.5. So your borrowing repayment is 105.96, investment is 106.5. So you can show even the amount terms, but amount term generally I do not advise, because your institute gives the answer this way. So you technically should give the answer. The student actually faces a problem. You know why? He says, sir, how is the investment done at 7.8? We are doing the investment by a longer route. Actually this 6.5 is a composition of 5% and 7.8. That is why the language comes this way. Now you can read slide as per your convenience. Quickly read please. Quickly read out. Once you're done, let me know. The slides are with you, I think. You can cross check. Is it fine? The slides are there, or when you go back home, in case you do not have the printouts, you can go back home and download. Now next I'm moving is cap, floor and collar. Cap, floor and collar. Again, betting contracts. Now cap is upside, floor is downside, collar is combination of cap and floor. It's an option contract on the interest. Now understand the flow of the topic first. If you understand diagrammatically, I'm saying at least the 70% of the question you will not face a problem. 70 means 90% of the question will not face a problem. The problem only comes in when a disputable data given by the institute. Otherwise the topic will not have any doubt. Now first understand what it means is, I have taken a cap first before I read the statement. I have the statements, I will come back to it. A person, this is a person, he has done some borrowing, let's say from bank A. I'm assuming he has done the borrowing, and he has done the borrowing at MIBOR, the interest rate. His fear, this dar is nothing but English language is fear. His fear is, if you do the borrowing, assume yourself, if you have done the borrowing, your fear is interest rate going up. So his fear is interest rate going up. Now sir, if my fear is interest rate going up, I could have done the fixed borrowing. Maybe you did not get the fixed, it was not in your hand, you did not get, what can you do? You can do nothing. So the fear was interest rate going up. So loan taken on MIBOR, interest is payment, actual loan. Now to mitigate this, he enters into a contract. That means this is actual. This, whether you take the cap contract or not, whether you do any kind of contract or not, this flow will take place. You have taken loan from someone, you will repay what? The interest amount. Now what he does is, his outflow is what? Interest. His fear is interest rate going up. So you do not even have to remember, I am saying, just think logically that what kind of a contract I have done. I have done a contract in which I am paying what? Interest. That means if I have to hedge myself, I'll do a contract in such a way interest is coming to me at MIBOR. Understand what I'm saying? Even in fact I'm saying, do not even remember what is there. Cap is upside, cap is that, technically everything I'll tell you. But the best way to remember is, if I have a fear that what I'm giving is, I'm giving the interest rate, if today interest rate is 8, if tomorrow interest becomes 9, if after that interest rate becomes 10, I have a fear. If the interest rate keeps increasing, my interest outflow will keep increasing, and I want to hedge. And someone told me, if you want to hedge, you can do a contract in the cap. Then you started wondering, what is cap? You, in mind, one thing is clear, my interest should not go above 8%. So you will do some other agreement. This agreement is as it is. This will not change. If the rate is 8, I'll pay him 8. If the rate is 10, I'll pay him 8, 9. If the rate is 12, I'll pay him 12. If the rate is 14, I'll pay him 14. But I'll do such a contract in the second market in which anything above 8, if I'm assuming anything above 8, I'm able to pay. That means I'll say, will you give me MIBOR? I'll give you something fixed. That means what kind of a contract I'm doing in the cap, floor and market. This is actual. So I'm doing is receiving of what? MIBOR and paying of fixed. How did we decide fixed rate? We did not decide, question will tell you. In practical life, you know what maximum you can go. You are okay up to 8, anything above 8, you have a fear. Now that means, if I talk about now this contract, what kind of a contract it becomes? This becomes in which a cap holder, a person who is a floating rate borrower, will hedge his interest rate risk, in which he will do what? He will take an option contract such that he will receive the floating and pay what? Fixed. And if I say it is as good as call option, call option is exercised when? Call option is exercised when rate goes up. If I freeze my rate at 8%, so think logically, if the rate is 6%, I am paying 6%, I do not have any fear. If the rate is 7%, I am paying 7%, I do not have any fear. If the rate is 8%, I am saying I am okay. If the rate is 9%, I do not want to pay more than 8, but I still have to pay him what? 9. I paid him 9, but I want the contract should give me what? 1%. It means if I decide my rate as 8, anything above 8 will give me what? Amount in hand. So we say cap is nothing but upside betting or downside upside. It is as good as call option. In exam, just remember it's C plus on the interest rate. That's it. It's a call option on the interest rate. Do not even apply the brain, please. It's a call option on the interest rate. Holder in favor, writer against. So writer question can come, it can come. Call option, how did we do derivatives? Call option would be exercised when price goes up or the rate goes up. If the rate goes up, it will be exercised in favor of holder against the writer. Now you can make any rate. Let's suppose rate became 12, sir. How much you will pay? Actually 12, but this contract will give you how much? Payment of 8, receipt of what? 12. 4, this will give you, ultimately your costing would be what? 8. Do not change this. This will remain as it is. Means this will remain as it is. What will happen is the subsequent will save you something. Is that fine? Now let me read out theory if it comes. It's an option contract on the interest rate. A fixed floating rate borrower hedges his risk of interest rate rising by taking option contract such that he receives floating and pays fixed. So how will I remember he receives floating? If your outflow is floating, you want to safeguard your outflow. So that means whatever is your outflow, same thing you want what? Inflow. Same thing you want inflow. Since it is an option contract, hence he will pay premium. This is as good as, this is the best way I remember. C plus on what? Interest rate. This will be exercised when rate goes up. This option will be exercised if the interest rate rises. The rate at which contracted entry is known as a cap rate or a strike rate. Is that fine? Now I am not moving to the next slide. I am asking you, let's suppose you have given the loan to someone on floating rate. If you give the loan, you give it to me only. Actual, I am paying you 7% as of now, and this will happen this year. Since inflations will come down, if the inflations will come down, the rate of interest will come down. If the rate of interest comes down, let's suppose it becomes 6. In your hand will start coming what? 6%. You think yourself to be a lender now. You have given me the loan, amount leave, and I am paying you 7%. You are happy with 7%, and anything above 6% you are happy. So you are getting 7. The inflation cooled down, the RBI's, Fed, etc. The worldwide the interest rate came down, to 6. Now I'll pay you how much? 6. You're still happy. Now rate further came down, inflation came down, rate becomes 5. So you will receive how much? 5. Your fear is what? Interest rate reducing. You want minimum in your hand should be 6. Now you are receiving. So that means if from me you start receiving less than 6, you want to create such structure who should give you the balance. That means I am giving you something and you want to create such structure in this, you will receive structurally. That means you want fixed at what rate? 6. Up to 6 it's no problem. That means instead of now this way, if let's suppose you create a structure in which you pay floating and you receive what? Fixed of 6. Option contract. This is only option contract. If you are receiving more than 6, this option contract will lapse, because you will never pay him floating. Let's suppose rate is 8. You will never pay him 8 and receive 6. You will never pay him 9 and receive what? 6. But if the rate becomes 5, you will pay him what? Only 5 and receive what? 6. And your actual interest which I was paying was also what? 5. So 1% you will receive from here and 5 you will receive from me. Total in hand will come what? 6%. That means if lender is thinking his fear is interest rate falling. Interest rate falling is which type of a contract? Put option. So we will take a put option. The P plus. If the rate goes down, you will be able to exercise. Now if I go back, now it's written in Hindi, English we call it as loan has been given. This is actual and you're receiving the MIBOR. Your fear is, this is fear. Your fear is interest rate decreasing. You freezed a rate in which you'll receive 6 and pay what? MIBOR. Till the time you're receiving more than 6, option contract is getting lapsed and you are receiving more than 6. The moment you start getting less than what? 6%, you will exercise what? This option contract. So we say this is an option contract. In a floating rate, lender will hedge the risk of what? Interest rate decreasing. He will enter into such a contract in which he pays what? Floating and receives fixed. Since this is an option contract, hence premium is what? Paid. This is as good as put option on what? interest rate at this would be exercised if the interest rate falls. If the interest rate falls, only two things remember please. Cap is a upside because your fear is interest rate. If you logically want to read the slide. If in exam you do not have a time, do not even spend time. Call option cap is C plus. Its rate goes up, I'll get compensated when the rate goes up. The downside is for lender. If the rate goes down, I'll be compensated here. You wanted to free something. It's a put option, as good as a put option. That's a simple cap and floor which comes out. Now, third type which comes is the collar. In the collar strategy, actually what happens is cap involves a premium cost, put involves a premium cost. So he wants to hedge himself. In the next slide, do not read on your own. Do not read on your own. Let me read out. In fact, this slide, let me read out from my notes first. This will make a fear for you. So let me do one thing. This is which topic we are doing? Interest rate. Interest rate risk management. Na? Very good, sir. Cheapest to deliver. Blah blah blah. You do not do anything. Let me. Yes, very good, sir. Very good. This is how it works. Look up, please. Everything is given in the note also, but maybe it's a cumulative slide, so you will not enjoy reading it from there. Let's read from here step by step. Collar. It's a combination of cap and floor. Objective, remember, objective is to reduce what? Premium cost. That is the most important objective. Now look up please. If you get at the first glance, you will not face a problem. Do not ask how, why, etc. Just ask, is my objective is getting fulfilled, and what is your objective? Floating rate borrower. What is the floating rate borrower? You become a borrower. Floating rate means you have borrowed at a floating rate. If the interest rate changes, your outflow would change. Since you are a borrower, what is your fear? Interest rate going up. Your fear is interest rate rising. Since your fear is interest rate rising, if I go back and try to check, we have done which type of option just now? Cap. So that means if you do C plus at 8. Now think logically, what is C plus 8 means, sir? If you take only cap option, you will pay outflow of premium on what? The cap option. If you would have taken only cap, I'm not talking about collar, I'm just telling a floating rate borrower. I'm just putting a floating rate borrower has a fear of interest rate increasing. If he goes for cap option, his fear is the outflow of a premium, and if the rate is 8 and below, option will be lapsed and he will pay 8%, 7, 6, whatever the rate is. If the rate becomes 9, your actual outflow is what? 9. If the actual outflow, leave the option contract. If the rate becomes 10, actual outflow is what? 10. If the rate is 11, actual outflow is 11. Now, if you have taken a cap option, the moment it goes above 8, you will get compensated by the balance. So, would be exercised in favor if the interest rate increases. Sir, if the rate is 7, actually 7, option lapse. If the rate becomes 6, option lapse. And you are happy if the rate goes down because premium anyhow you have paid. So, you would be happy rate going down. Now, there could be a possibility, some of you would say, sir, I am taking the option contract, I am paying such a huge premium. My fear is interest rate going up. If the interest rate is falling, I am not fearing. I said, okay. Sir, if by chance the interest rate becomes 4, I am very happy that interest rate is 4. My actual outflow will be what? 4. And my cost will be, premium is anyhow getting what? Lapsed. So I say you can do one thing. If you want 4% you are happy, then you can reduce your premium cost. Reduce your premium cost. Now how do I reduce my premium? Understand the objective. My objective is to hedge what? Upside. First objective was to hedge upside. Now taking cap, I have done that. In collar what I am doing, I'll hedge myself of upside plus I'll reduce my premium cost. And then I did was what? I did C plus at 8 and P minus. Sir, what is P? P minus. That means I become put writer at 4%. Now let's think what will happen. First, let's think what will happen. If the rate is 8%, cap option, the cap will lapse. If the rate is 9, cap will be exercised in favor. Actual outflow 9, receive 1, net outflow 8. If the rate becomes 10, actual outflow 10, receive what? 2, net outflow 8. It's okay. Now put option. Put option would be exercised when rate falls. Don't look at put writer. Only look put is at 4. This option would be exercised when the rate is what? Below 4. Rate is 7%. Call option would lapse. Put option would lapse because put will be exercised only below 4. Rate is 6%. Cap above 8, put below 4. Both option would lapse. Rate is 5. Cap put both will lapse. Rate is 4. Put is also lapse now. Below 4 na, put is also lapse, cap is also lapse. That means between 4 and 8 or anyhow when you do C plus and P minus, one thing is sure, you have reduced your premium cost and you have made sure that if something goes above 8, which anyhow cap was also safeguarding, collar is also safeguarding. But by writing put I have made sure I have reduced my premium cost, and by chance it goes below 4. Let's suppose rate becomes 3. I am giving 3% actual, call option lapsed, but since I was a writer here, put would be exercised against me. That means I'll end up paying what? 1% more. Total is 4. Sir, why did he take at 4? Because he was happy enough at 4. He said anything up to 4 is justified till the time it reduces my premium cost. His objective was not to earn premium. His objective, two objective: upside protected and downside. Up to 4 he was happy, and reduces what cost? Premium cost. Reduces premium cost. Call option would be exercised in favor when the rate goes up. Put option would be exercised against if the rate goes below what? 4%. Now let's look at this chart here. Do not read this because in the class I do systematically. Since you are finding combined chart, do not look at that combined. What I'll say, only look at that. Actual loan taken by borrower at what rate? MIBOR. Now then I make this structure. Actual loan taken at MIBOR. No hedging done. This structure is not with you. That's why I was saying maybe I by chance have given the put option in that slide. It's okay. Actual loan taken at MIBOR. If the rate is 3, your outflow is what? 3. Rate 4 outflow 4, rate 5 outflow 5, rate 6 outflow 6, rate 7 outflow 7, rate 8 outflow, etc., etc. Everything is same. Nothing has changed, no? Because if you take actual outflow and if you've done this, outflow would be there. Now let's suppose you have taken only cap at 8%. First was actual. The from whom you have taken loan, he is not concerned whether you have hedged or not. He says rate is this, give me this interest rate. Now let's suppose you have taken what? Cap. If you have taken a cap at 8%, that means call option would be exercised when? Above. Actual will remain as it is. No change in actual. Now it will be exercised above what? 8. That means since you are C plus, you will get 1%, you will get 2, you will get 3, you will get 4. If you combine both of them, see your costing. Maximum costing is what? 8. Maximum is 8. Now you thought that since I am paying so much of a premium, let me reduce what cost? Some premium cost. Then you tried collar. You write P minus here. Now do not look anything else. Let me show you this. Let me show you first this part here. Up to 5. Actual rate 5, you end up paying only 5. Actual rate 6, you end up paying what? 6. Actual rate 7, you end up paying what? 7. 8, 8, and if it goes above 8, still you are paying what? 8. Have you reduced your premium cost? Yes. You reduced because you are put writer. Only problem you might think is, sir, here he has to pay. It's okay na? He is happy to pay 4%. He says, I am happy. It is reducing my what? Premium cost. Understand the objective. If I do not do anything, fear is on me. Understand 3 parts. Do not do anything, fear is the rate going up. Someone told me cap, you brought the cap. You get hedged what? Upside. But the premium cost was very heavy. Then you write P minus, you make collar. That means upside is still protected. Downside, you are happy to pay 4. Because you are happy to pay 8 also by taking cap. And that means you are happy to pay 4. I hope you are getting my point. If you want to take a screenshot of it, take it please, so that you remember 3 parts. If you remember, my question doing would become easier. Because question you combine both of them and that creates a problem. The objective is, do not take my photo, take this one. So it's the combination is basically what comes out is, it's a actual outflow will remain as it is. The cap if you take, you are happy paying up to 8, And if you are getting a safeguarded below, you are happy to take this part here. Sir, how do I decide to take C plus? Look at the objective of the exercise. Your first objective of the exercise was protect from upside, and if you want to stay there, only cap. And if the objective is additional, is reduce premium cost, then what will do? P minus. Similarly, a lender, think from the perspective of lender. Think from the perspective of lender. In objective is to safeguard from what? Downside. So he'll take what? P plus. He'll be safeguarded. If the rate goes up, he's happy. If the rate goes up, he's very happy because he's getting more. And if we want to reduce premium cost, he'll do what? C minus. If he does C minus, sir, his upside would be limited, because actually what happens is, in theory it might appear very weird to you that sir, upside would be the protected in this case, but if by chance rate becomes 10, he is very happy. He never thought 10. He was doing his P plus at what? 4. He was thinking only 4, rate below 4. By chance 10 comes. He is so very happy that he says it will never come. He is trying to reduce his premium cost which comes out. So that's about the put option. Basic objective is, when you make these kind of strategies, always try the fear. Fear can be protected by this, and if you want to reduce premium cost, you do put minus. Up to certain point, you are happy to pay the interest. Similarly, if you look at the lender fear is what? Rate going down. So he will protect 4. And if by chance someone gives him 10, he is very happy, and to reduce outflow of the premium, he can take C minus at what? 10%. That's fine. Now let me read out a question with you. Let's come back to the question. This slide has something of that sort. When you go back home, it becomes easier for you to read the slide now. Let me come to the question. Question number. Read 15th question. Read question number 15 once. In 2 parts we'll do it so that you understand reasoning of it. MPD issued 50 million floating rate loan. Borrower or lender? Now look at the problem, and this is not the first time, whether it's a regular batch, exam oriented batch, revision class, non-revision class, and you have to do so much. Company issues debenture. Borrower, lender. Company issues debentures. It's a borrower. And every time I ask this question, the thinking process starts borrower, lender, borrower, lender. It's not about you. Actually, when I also read first time, it happened with me. It's something which issues. It means he has taken floating rate loan. Now, without going forward, I'll ask you to read on your own. You tell me, when you borrow, your fear is what? Rate goes up. Which type of option you should take? Cap. So your framework should start cap. If it's a cap question, he'll give you only cap. And C plus anyhow you'll do. If he says you have to reduce premium cost, then second would be P minus. Now read the question. Problem with the question, I'll tell you. This was disputable question. First time I think 2013 somewhere RTP question would have come. Question was not this, similar. Answer was given. Then that question came in the study material, slightly answer changed. That kept. Then it came in the exam, this examination question. Answers changed. And then someone told me, neither you can compare with the first one, neither you can compare with the second one, and third one removed from the study material and the practice manual. So this question will not find problem. It's easy for them now. So means when you have a no competition in the world, do whatever you want. So it's removed. It's not there. Problem happened only when I used to do. I tell you very frankly. First time when it came, institute gave. I used to take 6 months time period. So if I take 6 months here, no dispute will come. I sometimes feel very strange why examiner wants to test in a number of days. If we give 6 months days, this question will not have problem, because the problem was he was doing something else earlier, then he started doing something else, the problem started there. Because if I take 6 month period, whether the first 6 months or second 6 months, the number of days would be same. The moment I convert into the days, problem happens. And then came leap year. So problem is, I don't know what they want to test. And this has been situation with the institute, with the paper setters over a period of a time. So it remains, it does not change. So in this case, I'll try to tell you dispute. I telling you that first time dispute was they were betting on something, then something changed. Then second time was they were taking periods differently, and the actually what should be taken is the correct what they have done now. But since it had a problem over the last years, they have removed it. We'll do exactly same. I am assuming next time when the question comes, one thing, leap year will not come. I've taken leap year so that the maximum possible strength is this only. Else I could have taken the practice manual question only with modification. Second is, when the question comes, start making your framework that you are taking a cap option or a floor option and what type of option you are taking. Once you streamline that particular thing, then at least 90% things become easier for you. For example, let me tell you that let's say he says MPD issues 50 million floating rate loan on this date, resetting coupon every 6 months equal to LIBOR plus 50 basis point. It means no matter what happens, the actual outflow will take place what? LIBOR plus 50 basis point. And then after that is something says, you read once, then I'll read out with you and then I'll tell you how to do it. Read out once. Means divide in two parts. One is actual, which will remain actual. Nothing would change. If I try to read out now, it says MPD issued 50 million floating rate loan on July 1, resetting of coupon 6 months equal to LIBOR plus this. Your actual cost would be LIBOR plus 50 basis point. First point, remember this. MPD interested in interest rate collar strategy. Selling a floor, buying a cap. In fact, you should know the correct way should have been C plus P minus, because first I hedge myself and then to reduce my premium cost I do what? P minus. Principal amount same. Strike rate is 5% for floor and 8% for cap. Reference rate 6 months LIBOR. The initial answer which came, he did betting was on, means when you were one is actual loan you are paying what? 60 plus 50 basis point. Then second is we have to see whether cap would be exercised or P would be exercised or not. When he was checking that, he was checking on I think L plus 50 basis point. But betting is not on L plus 50 basis point. Betting will be on LIBOR. So two important points write down first before I move forward. First, actual cost is actual cost is L plus 50 basis point. Actual cost is L plus 50 basis point. Second, betting is on LIBOR. Betting is on LIBOR. Betting is on LIBOR. Now next part. Reference rate this, premium is nil since premium paid is for premium receipt for this. The reset date, interest rate on that dates are LIBOR, they are given. If rate is 7, then actual loan you'll pay is 7 plus 0.5. If rate is 8, you'll pay 8 plus 0.5 and so on, you'll pay out. That is exactly you'll pay. Now problem, actually let me not tell you the problem now, let's directly go to the solution only, because you'll get confused. So let me go, what will happen? Can I move forward? And second, he says calculate overall effective interest rate per annum. So two parts we have to calculate. One we have to calculate is effective interest at each 6 months. That means two parts will divide in the first. One I'll divide is effective interest paid is actual loan, and then strategy, and then whatever interest paid effectively what. Now remember the period, we are standing where 31/12/2018. Now let me go back. If I go back here, for example 31/12, now do me a favor, calculate the number of days, calculate the number of days from 31/12 to this date. Calculate the number of days from this date, what comes out? How much? 181. That means when you pay the actual interest, if I show you, now two things will take place. If you try to look at this part here, from here to here 7.5 rate is known here. What will do, cap and float will see secondary. So I end up paying the interest of 7 plus 0.5. How much? The how many days? 181 na? January, Feb, March, April, May and June. I end up paying for how many days? 181 days. So if I try to summarize now the first part of the structure, I say actual cost is L plus 50. Betting would be done on LIBOR, which we have not spoken till now, and not on L plus 50. Interest, we are standing here, interest would be paid at 7% was the reset first 7%, na? And how much? 50 basis point. So I say actual loan would be equal to what, sir? 7 plus 50 basis point. And collar strategy, if I look at, it's buys cap at what? 8 and sells float at this. It would be exercised in favor if the rate is above what? 8%. And which rate above 8? Only LIBOR. Anywhere LIBOR above 8? If you look at, I think no. Anywhere LIBOR above 8? No. It's up to 8 na. So that means call option would not exercise. Put option would be exercised below 5. Favor against, I'm not talking. Below 5 na. Anywhere above below 5, these two 8s. Is that fine? Now let's just copy the first part here, this part if you want. So this exam you have to show, maybe no. This is only for reference purpose, so that you know what you're doing. We're dividing our concept into two parts. What we're saying, the actual loan will be paid no matter what happens. The collar would be exercised when buy is cap at what? 8 and sells float at what? 5. Copy that part first, please. Then I'll move forward. Once you're done, let me know. The structure, sir, what does it help? It only helps you in making your understanding. Actually, when you look at both combined, there is a 100% chance you'll make a confusion. Actually, you have to pay no matter what happens. And simply remember, cap I'll exercise when the rate is above 8. Anywhere it is not, that means it will not be exercised. put will be exercised when below. Actually, he has given call and put premium, both are cancelled out, but generally do not get cancelled out. It's easier for you to This is done. Call and put I'll do separately. Let me do first the first part. I'll take date 6 months LIBOR, and then my payment is what? 6 months LIBOR plus 50. Then I'll tell you date of payment. Date of payment is if you're standing here, payment is done here. If you're standing here, payment is done here. That means you'll make for how many days? 181 days. Then rate you'll know here, and it is as good as the borrowing. Payment you will make. What date will come? 31/12/19. Days would be, sir, if it was 181, the problem was not there. Feb is this. I'm saying if it was 6 months, actually first time your institute takes these days. The correct is this. That's what I was saying. If I would have taken 6 months, the problem was not there at all, because whether first or 6 does not matter. But if rate I know here and loan I take here, it is actual loan. It is not the settlement. There is difference between settlement and the actual loan. If the loan I take here and I'll pay interest as per this rate till here, that means if I would have taken 6 months, there was no problem. Since I am calculating the number of days, it will be number of days. Now if I know the rate here, it is as good as I went to someone, I know the rate here, he'll give me the loan at what? This rate and these number of days. July 31, August 31, July 31, August 31, September 30 days, November, no, how many months comes now? Like July, August, July, August comes na, July only comes, result comes July, August, September, October, November, December. Total how many days? 184 days comes. And the problem does not end here also. The next payment would be one. No, leap year comes. The problem is, how do I know leap year? I don't even know the year in which I am writing the exam. Leap year. I have taken this question for the purpose. This only you can solve. I cannot even do anything of it. No matter you criticize to any extent, they'll give what they want to give. Actually, they do not know what they're giving. Problem is not this, what they're giving. They also do not know what they're giving it. When they realize, they come to know we have made a mistake. So it's like a child which happens now, you keep telling him, my son, I keep telling him, sit and drink water, sit and drink water. But still he'll do the opposite. So he does not know what he's doing. Exactly same thing is with him. Now checking a leap year, changing 3 time answer. If at least this question came, I would have expected whatever answer you gave. First time you gave wrong, you rectified, put it in the study material, it's okay. Then second time when you put it, it's okay. Or you could have given 6 months. Problem was not there. Whether leap, non-leap year, it does not make a difference. He wanted to check. He should have wanted to check this concept only. But rather than problem came, this is one problem. The other problem is the number of days which comes out. That is the problem which comes out. I'm not expecting next time the leap year extra comes, and I'm 99% sure. I don't know why I'm feeling. He'll say assume, instead of number of days, assume 6 months. If they have to rectify what they have done, then I'm assuming next time when this question comes, they'll say assume period of 6 months. And if you assume 6 months, then there is no challenge at all. There is no challenge at all which comes out. But anyhow, we'll do as per this only. So it will be next period, according days will take. This will give me only first part. Actually, question should have been tougher on the second part. Second part does not have anything. It's only number of days we are calculating. That's it. So what I have, then I'll find actual output. So 2 parts I have done. First part. Look up. First part. I'll just show till here only, so that numbers you can calculate. Look up, please. Reset date, 6 months LIBOR. This plus date of payment, number of days, actual outflow. These are the dates. LIBOR is known, I think, every day given 7, 8, 6, 4.75, 4.25 in this. And this is what? 7.5. So how did we get? Plus 50. Date of payment next. That means from this period to this period, the number of days are 181. The problem was these two. But sir, leap year impacts only first 6 months. It impacts only first 6 months. But total when you take 366, it will impact 2. After that, there is no challenge which comes out. So quickly find out this is actual outflow. Then we look at the cap and floor. The cap and floor. Cap will be lapse at all point of a time, and put would be exercised in the last two, uh, 4.25 and 4.75 years. So these rates we compare. We'll see separately. So cap will be a receipt, floor would be a payment. That we'll see differently. Quickly copy that part and calculate the answer for me, the last part. Then I'll show you the last part. My best advice to you would remain is, if in exam anything of weird thing comes which you think is a problematic, especially these kind of thing, number of days, and you have the choice, then leave this in choice. And I generally in the classes also say, attempting 100 marks and getting 100 marks is an imagination. Try, maybe if you attempt correctly 80 to 90% of the paper and you score 70, also 75, it's genuine enough, rather than come back home and crying on a question, this question was wrong, I could have done this. I know there is luck factor also, I cannot help it out. It's something very weird. Institute has to take ultra carefulness. So one thing is, do whatever you want. In exam, do not start thinking this way, because this question could have been this way, I could have passed, etc. You do not know in your hand what is there. And give the attempt, try to attempt the maximum. In case you feel something is problem, then exam you have such a pressure in which you will also have to think which combination to select and which combination to leave. So exam do not do anything. When you come back, then we'll do the criticism which has to be done. In exam you think that whatever they have given, I do not have, because if I have the choice to correct in the exam, it's okay. We do not have the choice. In exam, the best choice which comes is, try to analyze that I can touch the maximum part of it. In this question, I was not assuming. In fact, it was straight away, I say, it was crime on the students. In this part, I'm saying it was crime on the student which they have done. Because when you give something and you change suddenly in the exam, then you cannot do anything, which was crime basically. I expected them to give the grace marks anyone who attempted this question. But if something comes very weird which you do not know how to even touch, then in that case do not even touch, because you'll get demotivated for the rest of the paper also. This was actually something which everyone knew 100%, and without any mistake of theirs, they lost the marks only because of this structure which comes out. And even if they would have corrected now, some would have lost the marks because of the leap year also. If I do 6 months here, the number of days, things becomes easier. So attempting a 80 to 90 is genuine enough paper. It is not about my paper I'm talking about. It is about, could be about any paper which could be there. So in exam, when you're under the pressure, the objective is you have to feel the pressure and accordingly manage it, because it's not only the numbers, or not only everything is doing, because CA final, if you know everything or 100% you keep scoring, then it is not a CA final at all. And only thing they can derail the train is, means they can make you score lesser is by making these mistakes. So assume they'll give the mistakes, but what I am assuming, they are not even correcting. It's not one after the another, and if they have the best option, then remove from the material itself. Nullite. The best option they have is remove. But when you're trying in the exam, make sure next time when it comes, two things will happen. One, I think either leap year would not come, and if they have to really rectify and want to test your knowledge, then instead of number of days, give it 6 months. Because anyhow, calculations are also lengthy. When you're doing, you will come to know. When you do, the calculations are also lengthy. It's not small calculation. So if I get my first answer, in case you have copied, it's okay. Cross check the numbers. Then I'll see the cap and flow. If anyone has understood, below I have made separately cap, receipt C plus, pay for floor P minus, and net outflow. So cap would be lapse at all point of a time. Cap would be lapse at all point of a time. You can make accordingly. floor you can show the outflow, because since it's above also outflow, below also I have taken the outflow only. Outflow plus outflow, total outflow calculate, and then total outflow would be for the number of days total are 1096, and he said I think effective calculate per annum average. One good thing which I think can happen over the period of a time now would be, since you will have a MCQ, unless until they make a blunder, at least 30 marks you are safe. Unless until they make a blunder, because what happens in the paper, AFM, what happens actually is decimal places. This is one part. Second is decimal places. You keep asking me, I'm helpless. If they give 5 digit, 3 digit, 4, it's good for you. Earlier at least capital budgeting was not there. Now capital budgeting has come back. Problem is 0.909, 0.9091, what should I use? And every time you'll ask me, because your expectation is okay from a teacher, but what will teacher do? Even I don't know, if you ask me very frankly, what to take. I take a standard rule, it's a 3 place rounding off. So what I assume is, in the case of a case studies or MCQs, at least they should not give answer one is coming on 3 digit and one is coming on 4 digits. Then only God can save you. I don't know who will save you. At least they should give such a difference which clearly indicates a difference. And in this case, capital budgeting was not there, still better off. In the derivative also we have the same problem, 2 decimal, 3 decimal, figures are in lakh, how many decimals? Generally they should use a convention. If crore figure is there, 4 5 decimal okay. If lakh is there, 3 decimal okay. If some number is 100 only, now 100.001 you will not put, means they should know. They calculate answer in 25 paisa also, 35 paisa, it's their wish only they calculate what. And it is not the institute who takes, it's the paper setter. They should give a guideline to them that you are creating a paper for a children and they are living in a AI world. You are using a calculator till now. Remove that calculator. And when you are making a paper, make a paper and do it accordingly. They'll come to know. So the problem comes because of that. Try for cap floor and net outflow. Second part was cap receipts, floor and net outflow. And please remember, the above was outflow, this is outflow. This will increase your cost. The above was outflow and this is your outflow. The above was outflow and this is outflow. This will increase your cost. I hope we have written the statement that betting we are doing along with the LIBOR. We are comparing with the LIBOR, not plus L plus 0.5. So that one mistake could be there. Second is this. And then he says calculate the annual effective interest rate. Calculate the annual effective interest rate. Done. Next part is also very, very important. It's easier but very important from the exam perspective. The next part I think is non-mistake area, but I think we have made a mistake in that also at one place over time. Means even with a bare eye we cannot make a mistake in that. One question they gave, I think might have given you here. The question 2010, a very weird question which has not repeated itself for a long time. So something which can come from that side. Before we go there, let me come back. The next part of it. Next part we have, this was collar strategy, what we were discussing. Coming back to the interest rate swap. Second part of it, coming to the interest rate swap. Interest rate swap is based on the comparative advantage theory. Interest rate swap is this is interest rate swap based on comparative advantage. What is the meaning of this is fixed floating preference. So what is the objective? With this example only we'll get the objective, don't worry. There are two friends, Sam and Sham, or maybe known, unknown, etc. Anything could be there. In the fixed market, in the fixed means he went to the bank and said, I want a loan. The bank said 10%. Sham was getting loan at a 15%. Floating rate, the Ram is getting loan at L+2, Sham is getting loan at L+5. Now, since Ram is getting a better rate in both the markets, we call it as the comparative advantage theory. That's called comparative advantage theory. In this, Ram is getting loan at a cheaper rate in both the markets. If you look at, I have highlighted something. Preference is Ram wants a loan at a floating L+2 and Sham wants a fixed 15. If they go with their own wish, their total costing will become is 15 plus L+2. That will become L+17. If somehow they do the opposite, rate will become L+15. So prima facie we can say there is an advantage which comes out. This theory is exactly based on the principle. You are at Ameerpet and you want to go, let's suppose there are two friends, one want to go Panjagutta and second wants to go, let's suppose Lakdi Ka Pul. Now Lakdi Ka Pul comes after Panjagutta, this way, it comes after Lakdi Ka Pul. There are two options, he takes one auto, he takes one auto. The costing will come, let's suppose he charges 100 and he charges 180. Total costing is 280. Someone advises them, instead of taking two autos, take one auto and let him sit in this auto only and he'll drop somewhere in between and go further. Total costing comes 180. Auto wala does not know whether he wanted to take two autos or a single auto. As per you, he should have, basically he'll drop here and whatever saving you have 100 rupees, you can divide as per your wish. Exactly same thing we are doing. In this example, if you look at, I did not compromise his place of a drop at Panjagutta. His place would be same. He will reach at same place with the reduced cost. He will reach at same place with the reduced cost. Exactly same thing happens here. If Ram wanted a floating rate, he wanted a fixed, I might ask them do the opposite. I'll ask them do the opposite, but I'll create a structure between them in such a way that their end answer would come in the floating and his end answer come in the fixed and at a reduced cost. And prima facie in this type of a question, you'll come to know the answer. How, sir? If L+2 plus 15, total costing is L+17. Reverse, if you look at, the costing would be L+15, which comes out. So there could be saving. Do not think, sir, if you ask them to do opposite, there is a problem. There is no problem, because I'll make sure that two agreements will take place. One, when they go to the bank and take a loan. Second, internally they'll do some adjustment, and adjustment would be done in such a way which will reduce their cost. Two type variety of questions can come, in which one question would specify, second you have to do it on your own. Now what has to be done, sir? Basic answer would be known, that the total costing reduction would be 2%. Now I have given here why Lam wants to take a loan at floating. Maybe he wanted floating because his expectation is interest rate will fall, and Sham want to take a loan at fixed because his expectation is maybe interest rate going up. Sir, because if the rate goes falls, the cost will reduce. So Sham expects rate to go up. So instead of cost increasing, he want to freeze it at this level. Now then I've created this structure here. Create a swap between Ram and Sham. Overall gain is shared in the ratio of 3:2. Let's suppose they share the ratio in 3:2. So what we do is effective cost if they do not do any swap. Effective cost if they do not do any swap will come L plus 17. Effective cost if they do swap L plus 15. The saving comes what? 2%. So the saving comes as 2%. 2% nothing but it's called quality spread. So why it is called quality spread? Because the quality of Ram is better than the Sham. This word they will not use by chance MCQ if it comes in. So it's basically 2% is better off because Ram is better than the Sham. And distribution how they said 3:2. So 2% how will divide? 2% 3 by 5 1.2. Ram will take the gain. Sham will take how much gain? 2 into 2.5 0.8. Now if he would have gone on his own, Ram his costing was L plus 2 minus 1.2, his net answer will come L plus 0.8 and Sham net answer will come 14.2. Now sir, how did it come? Answer, this is you can do one way. Second way, if you want to show in the detailed working, see how exactly it comes in. Process which comes out is, I'll show in the next slide. Look at this part here please. Effective cost of a Ram, pick up the Ram. Now what will ask him? Will ask Ram, you go to the bank and do the opposite. You go to the bank and do the opposite. Take a loan at what rate? 10%. You take a loan at 10%. Now sir, pay to Sham and this receive from Sham, how do you decide? This is decided how is I have taken a structural diagram here. Look up please. Look up. I have taken a structural diagram here. Ram is standing here. Sham is standing here. Ram went to the bank and asked him take a loan at what rate? 10%. Sham, I am asking do the opposite of what you want to do. What he wanted to take the loan at? Fixed. I asked him take a floating. This is done. Now in the first part we know effective cost has come what? L plus 8, which we know has come L plus 8 na? L plus 8 and this is 14.2. So we know this is actually a third part answer. This is actually third part. What I write is, I might have written here, in exam I will not write this way. In exam I will write third only. It is as good as at home you are doing a homework solution. I am not taking example of the income tax because it looks embarrassing. Otherwise you make an income statement etc. Let's suppose at home you are making income statement and one way is correctly make the income statement. Second is you know the answer and put the answer and then you tally the balance sheet. So you are doing exactly same thing here. You know his answer should come what? L plus 0.8. His answer should come what? 14.2. There could be n number of permutation combination. Let's fix any one of it. Let's fix any one of it and I am fixing what I have written here. I'll just cut and I'll do. Let's suppose I say this is 10% na. I can do any combinations. I am doing the simplest combination. Sham will pay Ram, let's suppose 10%. So if you look at 10% inflow for the Ram, 10% outflow for the Ram, and we know that if the gain is divided, his answer should come at what? L plus 0.8. Now if you look at this chart, in this I said I asked him take a loan at 10, him at L plus 5. I know their answer would come L plus 8 and his answer should come 14.2. Then I asked Sham, anyone you can pick, any combination you can make, go back home. I picked up simplest. I said Sham, you pay Ram 10%. Now when I'm looking at Ram, look at the Ram structure. Ram received 10, Ram paid 10. 10 inflow, 10 outflow went. We know his cost should come what? L plus 0.8. So I said you pay to Sham what? L plus 0.8. L plus 0.8. Now let's see the Sham. Outflow is L plus 0.5. Second outflow what he paid to what? Ram. Total outflow is L plus 15. Receipt is what? L plus 8. So no matter what the LIBOR is, LL gets what? Cancelled. So L plus 5 plus 10 was his outflow, L plus 15 minus L plus 0.8, his answer would come what? 14.2. So structurally, I know I'm saying no matter what combination you make, you know that his answer should come what L plus 8. The simplest way doing is that whatever one party fix one party, second party answer automatically come. Sir, if we would have done same from the RAM perspective, still the answer would have come same. Sir, show once. Either you take these two routes, or now I am putting in the black color. You say RAM, you pay Sham L plus 5. Let's suppose. Let's suppose. So look at the Sham now. L plus 5 is what? Outflow. L plus 5 is what? Inflow. Inflow outflow gets cancelled, and his cost has to come what? 14 point. And you tell him pay him what? 14.2. Now look at RAM. RAM would be outflow is what? 10. Outflow is L plus 5. L plus 15 outflow. Received 14.2. L plus 0.8. So no matter which permutation, any other also I can make any other. But I'm saying in the exam, fix up any one party, and you, for example, you ask him 10, 10 went. Since his answer has to come L plus 0.8, we said L plus 0.8. Now when I'm putting in the sentences, how do I put? Effective cost of RAM. Take loan from bank at what rate? 10%. Pay to Sham at what? L plus 0.8. Receive from Sham 10%. This is 10% receive. And then I say effective cost is outflow 10% to the bank, outflow L plus 0.8 to the Sham, inflow from the Sham is 10, your effective cost is L plus this, and this is your 1.2 saving which comes. If you look at Sham now, what has happened? He has taken loan from the bank at what? L plus 5 and paid to Ram at what? 10, received from Ram L plus 8. Outflow would be equal to L plus 5 plus what? 10%, L plus 15. Inflow L plus 0.8, 14.2, which comes out. So this is something which you have to make answer on your own. When you are doing answer on your own, then you have to adjust accordingly. That means you create on your own. First variety of a question would come, you have to do it. Second variety of a question which will come is case 2 if I take this way. If you look at case 2, in this he'll say same data Ram and Sham, create a swap between Ram and Sham such that Sham pays to Ram 11.6 and Ram pays to Sham what? L plus 1.8. So first we write is the structure exactly same way. We do not change anything in the structure. Ram 10%, Sham 15, floating and floating. Preference I write is floating. Preference I write is what? The fixed. But I asked them to do what? Opposite. Now look at the structure. Ram we asked go to the bank, take a loan at what rate? 10%. Sham do the opposite. Take a loan at what? L plus 5. Then he is only mentioning what to do. Sham to pay Ram how much? 11.6. Ram to pay Sham how much? 1.8. Now when I stand at Ram's case, I look at in the Ram 10% outflow bank, L plus 1.8 outflow to whom? Sham. Total outflow L plus 11.8. Received what? 11.6. Effective cost L plus 0.2. If he would have gone on his own, cost would have been what? L plus 2. So his saving is what? 1.2. 1.8. Saving is 1.8. Now I pick up the second party. Effective cost from the bank L plus 5. Paid to Ram L plus 6. Total L plus 16. Sir, what is L? It is hardly a material. LIBOR, anything could be there. It will get cancelled off. Inflow is what? L plus 1.8. Effective cost 15. On his own 15. Effective 14.8. Saving would be 0.2. Actually saving total has to be equal to what percentage? 2%. Because whenever you do the opposite, it will always safeguard. It will always safeguard to you. And if I was writing this step, I would write this step accordingly. Just quickly see that. Third party, I will include the investment bankers. Quickly check that out, please. Third part will add investment bankers. Done. Third part, investment banking, which comes generally in the exam. Actually, iBanks create a swap between Ram and Sham. So we say case 3. iBank creates a swap between Ram and Sham such that the overall gain is shared between Ram and Sham and the iBank in the ratio of 2:1. He'll only mention. So we divide the gain between them. Exactly same thing. When he mentions distribute the gain loss, there is no challenge. Whatever he says, make the structure, things become easier. In this case, what happens is, that means total gain would be 2/5, 2/5 and 1/5 between all three parties. Now when we make effective cost without swap, the costing is L plus 17, that is 15 plus L plus 2, exactly same thing. Opposite L plus 5, 2% saving. 2% saving would be saved between what? Between the all three. So Ram will get a share of 2% into 2.5. Sham will get a share of 2% into 2/5, 0.8. And iBank will get a share of what? 2% into 1.5. How much? 0.4. How much it comes? 2%. Effective cost after distribution of gain. That means Ram in itself would have got what? L plus 2. So after the gain, it will costing would be L plus 1.2. Sham on its own would have been what? 15. With the distribution 14.2, which comes out. Now diagrammatically when I make, now they will not share amongst each other. Now since iBank is in between, we say you write structure 10%, and in this case you write structure L plus 5. Now basically we know his effective cost has to come what? L plus 2. So iBank, I ask, give Ram 10%, 10 inflow, 10 what? Outflow. His answer has to come what? L plus 2. You make him payment of what? L plus 2. So let me draw this diagram for you, it becomes easier for you. Let's suppose we have Ram and then we have Ram here. Ram is dealing with the iBank and second structure is the Sham. If I draw how the diagrammatical presentation is drawn is, Ram we asked go to the bank and take a loan at what rate? 10%. This is done. Sham you ask go to the bank and take a loan at what rate? L plus 5%. Now what we do, we know in exam we'll write this a third step only please. Although I'm writing second only, his effective cost has to come what? L plus 1.2. Answer I know from the beginning only. Effective cost has to come what? 14.2. Now what I ask iBank is, iBank, you give Ram 10%. So 10% inflow, 10% outflow. 10 gets cancelled. If I look at this, 10 gets cancelled. His net answer has to come what? L plus 1.2. So I ask him, you give to him what? L plus 1.2. Just look at the Ram now. Ram will receive from iBank. Ram will pay to the bank and pay to iBank. His net answer will come L plus 1.2. Now I focus shift to the Sham. I ask iBank, you pay Sham L plus what? 5. So L plus 5 gets cancelled for Sham. His answer has to come what? 14.2. I ask him to make a payment of what? 14.2. Ram and Sham get settled. Now comes the iBank. If I try to make structure for the iBank inflow is equal to L plus 1.2 he'll receive from whom? Ram, plus 14.2 he'll receive from Sham, total L plus 15.4. Outflow when is making, to Ram is making a payment of 10, to Sham is making a payment of L plus 5, and total he makes a payment of 15. So inflow is L plus 15.4, outflow is L plus 15. Even the bank gets what? 0.4. Even the bank gets 0.4. Same thing I can put in the points form. Same thing if you want, you can put in the points form. that sir what is happening here. So one is receiving, one is making a payment, and accordingly you can draw it. That means you have to pick up any one of the parties, stand at that level. When you stand here, you get him satisfied, the I bank automatically will get satisfied. Is it fine? Now let me see if I can ask you, or I have taken which questions. If I have not taken, I'll ask you to do one exam question on your own. Let me check once. I don't remember if I have. You have not? This you can try. Fourth you try. I want net answer from you, that's it. Fourth you try, fourth. Now, in fact, before reading a question also I can come to know what question would be there. Look up please. Which two combinations are costly? L plus 2.25 and 1.75. How much total? L plus 4. So question would say you, I am telling you, question will say T wants floating US, S wants fixed yen, and opposite if we do, leave the currencies, opposite if we do, what is the costing coming? L plus 2.25. How much saving? 1.75. Even the question will say same thing, means you can make the question by looking at the data only. It will say T wants borrow dollars, S wants borrow Jap. Otherwise, if they were not asking same thing, then what would I do? There is no scope of the question. And 100 basis point means bank will take 1 and balance equally attractive to T and S. So quickly do it and let me know the answer. Just let me know the net answers please. If you can draw diagrammatically, very good. If you cannot draw, then I'll draw. This is which question number? 4. I have the net answer. I don't have the diagram, but I have the net answer. It's a fourth, no? Not fifth, fourth. How much saving you said? 1.75 na? It's 1.75. They will always do costly route. You will advise them a cheaper route. So it's L plus 1.75, and this do the opposite. You save 1.75. Share of the financial institution is 0.75. Balance would be 0.75, and the balance would be divided equally attractive, 0.375, and then you calculate their cost. What is their effective cost coming? My effective cost is coming. What will effective cost come? Leave the answer in their original format. We have 4th question. Should I show you the question? What was the What did S want to take? Floating, na? If he wanted floating, his answer would come in the. No, he wanted what? Fixed. He wanted fixed, na? His answer would come in the fixed only. 1.75 minus 0.375. Even if you draw a diagram, it does not make a difference. It will come same only. And his answer would come L plus 2.25 minus what? 0.375. This is the costing expense. This is the costing which comes out. Done? For more exam question, I would show you. But by chance, I might have answered the question only. So let me see if it is not there. Then you can try. Final answer should be what final answer is this. L plus 2.25. No, their costing will come this, na? No, what is the total cost? This is total cost is what? Basically, what has happened? If iBank was, how much both of them are saving? 0.75. If they do not do anything, their costing was L plus 4 minus 0.75. And how much it is coming? Your question is what? I am not. They have given to iBank, that's fine. If they would not have given then iBank, na, then their costing would have further reduced by 1% more. As of now, their costing would reduce by 0.75. If they too were doing something, their costing would reducing by total by 1.75. Since the iBank was there, so what is the effect on both of them? This effect should come on both of them, whatever the cost comes out. Let me see if I have not given the answer. Can you know what is the answer? No. Very good. You do not have this question, because if I do something squeeze up, you'll get to know the answer. This is the exact question. Do on your own now. In fact, prima facie you can make out. You know what question would be doing what? Let me clean up some exercise for you. Without reading further, make the combinations. Which combination is higher? This is higher, na? That means question would tell you they want Zaki floating, IB fixed, and if they do the opposite, the costing is L plus 2.75. How much costing reduces? 1.75, and he will take 25 basis point and rest equally. Find the answer. It's exactly same. Examination question, November 20, I think. So you can directly write the answer. 0.75 subtracted now. So if you subtract 0.75, whatever they want from that reduced. 2 minus 0.75, and 2.5 minus point. I hope you are getting, sir, what has been done? Total cost reduction, total saving is coming how much? 1.75. So I think it's 1.75 minus 2.5, it becomes what? 1.5, divide this, and this becomes the net answer. I think that's exactly the answer which should come. Check once. If we apply more brain, this will not get solved. Some questions have to done brainless. What is happening? Highest, lowest difference answer. Diagrammatically also I can draw something I can do, but few things are there which free fund marks are there. These are free fund marks. In this also I think some students were marks were cut. I don't know why. Like means some or the other way problem happens with these students. I don't know. I have my own feeling. There will be a parallel body coming very soon. I have my own feeling. This government comes next time, and then you'll have something. Monopoly, they will not improve. Actually, it's not about the body. It's about the examination pattern only. The rest thing, it's okay. They have the power, etc. But the problem is the examination pattern. The problem with this pattern, which I feel awkward, is those who pass, it's okay. Still the time you're a student, you will do everything. The moment you become CA, you will not even participate, even though you would have seen the same hardship. It's because someone who has crossed will not come back. Problem is, unlike rest of the courses where entry is tough, you enter, exit is, exit will become. In this, entry is easy. And once you it becomes a chakravyuh, and then you keep there. That's a problem which comes out. If generally someone asks me in the foundation, I very frankly speaking, because when I used to speak in the class in the initial years, that when you're doing foundation, take your call very cleverly whether you want to do CA or not, because once you come here, it's everything this, and at the end also you do not know this end will happen happily or not. When I started teaching, I remember I used to tell students, they used to tell, oh, you become a chartered accountant and you are advising us not to become chartered accountant. Then after a point of a time, I stopped telling them. At final, I never say, now go back, because at final you spend so much time. The articleship also you've done. Let me not take the name what you've done. So that period also you spent for almost free, everything. Almost prime period of your life in which you could have been roaming around somewhere, month of Feb, March, etc. But anyhow, whatever you've done. After that, at least I cannot tell you do that. The problem is they have to take a call what has to be done, and maybe they have to create the opportunities, because till the time more opportunities comes in, the pass percentages would keep running here only, and number of editions keeps coming in. So it's difficult course, I should say, difficult because of the results and plus some problem. If let's suppose they make the question easier, everyone passes, still everyone will not pass. They will means they have to do something. Then the job markets will get hit. I don't know what is the vicious circle which comes out. So this is a tough course. It's not an easy course. It's a tough course. Being a teacher, I should not be saying that should not do this course, but generally a student should know from the beginning itself that if I have that kind of patience, ultra patience level, then it's okay. And still at the end, actually end is not known. When you watch a movie, I know at the end nothing would happen, everything would happen in between. At the end, hero will win. So we know that. Similarly, in another course, you will know that I'll enter, I'll try rigorously, etc. Plus minus marks. I'll become engineer. I'll become this. Maybe some exceptional could have been there. But in this case, when you're giving a paper, you yourself would be wondering, even though you are the smartest of the students, this much of hard work that no course requires. This course requires such a hard work. They do everything, and somehow when I look at the CA students, they only have books in hand, they only have the registers in hand, the dates in hand, March 15, 31st March, this GST date, this return, this law, that law. They do not even have the time to open up the newspapers. So think of logically that if you cannot spend time on these activities, where would we stand? So somehow institute has to take a call. What has to be there, and it is not about the exam pattern only. It's about the creation of the opportunities also. Because after that point, such a hard work you put in, what kind of a salaries you get, where do you stand, where do you land up? So they have to create either exceptional uh, structure of this thing, because it's the conventional structure what you're studying in, and it's basically a structure in which your personality development is not taking place. Either they have to create such structure in which it can take place. They can make maybe pattern lighter, then have some training which I think they thought of 3 months, 6 months, 1 year, like MBA training programs like them, in which you can interact with the people, you can learn how to talk, how to speak, how to stand up. That gives you a personality development. So some of these kind of things are missing. I don't know. Everyone comes, they go, and if you ask me, we are not in a position, at least teacher is not in a position to do anything. And as a student, when you pass at this point of a time, you will feel all pain of the student, because you are a student. The moment you go, you become a CA, they leave out, and then the structure becomes different, because the students face that hardship, and that is because of the examination pattern. So that pattern needs some kind of a change, and the change should be in such a way that whether you pass with the lesser marks, whether you pass with the higher marks, ultimately one thing should be for sure: your personality should develop, which I have not seen over the period of a time. If you ask me very frankly, I have not seen. The talking skills somehow are lacking, the reading skills somehow are lacking, and maybe because it's a correspondence course. It's a correspondence only. Institute is they send you the books and they do it. It's only you come to the coaching classes or anywhere you go, you're doing it. Maybe you're going to the office, some part of it you are learning. That's okay. But that learning is also not coming. The kind of hard work you're putting in, that learning is also not coming in. So somehow they have to think very carefully about the creation of a structure. Maybe the MCQs they have done, I think they will do justice to it, and somehow the marks pattern improves. It's not about the marks. If it is improving only for the 10% only, then what was the difference in the old and the new pattern? There is no difference. The difference has to be, if pass percentage is not increasing, that means there is structurally some problem. It's easy to say student is not studying, they are not putting in hard work. Ask a student who's coming in 6 o'clock when he comes for the class and 10 o'clock when he goes back home. It's shameful for anyone to say they are not putting in hard work. It's hard work. I'm saying I have not seen any other profile putting in hard work as you. Means for, and rigorously. It's not about one month or 2 months, 3 months. Rigorously. And then think of a situation, if we are not passing, still we are putting in the same kind of hard work. Who has the courage to put in? So it's not about hard work. What I'm expecting is, with the kind of a change they have made when the exam happens, if the pass percentage improves, then it was justified. If that does not improve, that means there is some problem. There is structurally a problem that they have to think about it, because the career of around 70 to 75 students is on the edge. What to do? Those who have not come, or those who are new coming in, because the new entry comes in and they get stuck at this level. At least do something that they are able to survive in this competitive world. So there has to be few things which have changed. Because when I talk about, for example, specifically when I talk about finance has a number of streams, and you do not be required to be in the world of the calculators. You just keep putting the calculator. Your objective is to find 4 decimal places, 3 decimal places. The number is matching or not, answer is matching or not. There is a question which a software can do in the 30 seconds time or a 1 minute time. Same thing, you are spending 45 minutes time here. So these are not the kind of a pattern. It is something they have to rechange drastically about their study material, about the way of pattern of the examination, about how the question have to be asked and what type of question to be asked. And especially they have to put a focus on, when they're, at least it becomes the responsibility, moral responsibility them, because you are registered with them. As a teacher, when you come here, at least I know, when someone comes in my class, I remember first day I tell them, when you spend time with me, 3.5 months you're spending, the objective is not the course only, which anyhow you learn anywhere you go. If you are not able to learn about the practical side of the markets, if you are not able to speak, if you are not able to build up your reading habits, I have not justified. Means I try level missed. Only in this class I would not have spoken. Today I am speaking to you. Otherwise, in general classes, I make sure that 10 minutes, 5 minutes at the end or the beginning, anywhere, wherever relevant topic comes, we are able to speak on that topic, and you are aware that what is happening practically with your subject, plus what is the expectation of the world from you. And after that, I am assuming, since my time is very limited with you, it's the institute who has to take care when they're taking in so many numbers, when you're collecting fees, etc., everything you are doing for them. At least one part they should be working on is the development of the interpersonal skills. That has to be there. Now, how it will come up, why it will come, when it will come up, we don't know. Till that time, it only will remain a pattern of you give the exam, result comes, then there is an error, we do criticize, etc. But at the end, we stand at the same stage. And even if I tell you that it's okay, you will fight for you, or let's suppose anything happens, or we do, if the result comes positive, it will come only for maybe out of the 100 for one, but 99 has been done injustice. If it comes negative for anyone, then you have left your skills in the fighting. You only have the choice, do it, give the exam or do not give the exam. But that is not the way of moving in this kind of a course. So expectation is, when you, at least when you become a CA, try to be empathic, have some empathy towards the students, that you were also same stage. If you can contribute, because the members community has to be the strongest enough, if you can do something in which the overall structure can change, that gives a reputation to the institute also. Because when you stand, when we become a CA, you'll stand as a chartered accountant only. Now, language is not important, which language you're talking in any language, but at least you are able to express, whether it's a Hindi, English, Telugu, Tamil, any language, but you are able to express. That confidence level has to come in talking. That is something, at least I see, when I look at different patterns, I see somehow lacking, even if the articles are doing the rigorous articleship period. So somehow that institute has to take a call on it, how that can develop. If that develops, then I'm 99% sure, no matter what you do, you'll do very good. Because it's their responsibility. What is the objective of the regular colleges? It's not that colleges teach you a lot of things, or any kind of MBA institutes, or any kind of, it's not that they teach you a lot of things, but they put you in such an environment in which you develop as a person. You interact with different kind of personalities, you learn their ideas, you learn to express your ideas. This is something which is missing here, and that something has to be thought about it. Otherwise, theoretically, the way you do, the way you read, the same question, let's suppose what you do here, and the same questions were done with some normal person. In that scenario, what will happen is, if it was done with some other examination pattern, let's suppose, it is not that this will be kind of a keep doing this way, step by step. It's only, this is the process, this is what, and this is the net answer. So thought process is seen. In your case, it's the answers which are tallied over a period of time. So what I expect is, whenever you get a chance, whenever you are expressing yourself, make sure that it is the overall development of the structure of yours, not only from the study point of view, from the everything point of view, and then you can say that yes, you have actually done justice to the course. So pass percentages, I am assuming with the MCQs it has to improve. Let's wait for another 6 months what comes out. If that is not happening, and I'm wondering is, if they do not make a blunder with the MCQs, at least, because they have opened up the gate, they can ask any word from there. So for you also the work has increased. It's not work has decreased. For you, the work has increased more, because if they can ask anything from there, even if a one single point liner becomes important for you, which is beyond anyone's calculation what they'll ask. Anyhow, it was just a thought process which came in mind. We'll continue tomorrow. The part we have done it here, we'll continue from here. We'll finish up, and then we move to the capital budgeting, that new added. Take care. Bye bye.